All right, let's hit the movers board. This is where the weird stuff is already showing up. SPY's up a hair, QQQ basically flat, breadth mixed. So when you've got FGI almost doubling pre-market, that stands out. FGI up about 96%, 26 million shares, 81 times relative volume, and look at the float, barely over 500,000. That is why this thing can move like a video game. GXAI right behind it, up 55% with 226 times relative volume. Then LIMN, 16-cent biotech, up 48%, and that volume number is just silly. 168 million shares, 560 times relative volume. Oof. These are not sleepy opening prints. All right, let's pull up FGI. This is the top pre-market ripper right now. Oof, look at this thing. FGI is up around 95% while the broader tape is basically flat to green. So yeah, relative strength is the story. Small cap, tiny float, about 520,000 shares, and that matters because when volume finds a float like this, the candles can get stupid fast. The 1-minute structure is clean early, opened around 6.76, pushed all the way toward 9.70, and volume actually confirmed it. Big spike on that high candle. Now it's not straight line anymore. It's basing around 9.30-ish, and that's the whole read for me right now. Now the catalyst side, quick check here. The fresh headline is FGI announcing second quarter 2026 results after the close yesterday. That looks like the obvious spark for this morning's gap. We've got the headline in the feed. I'm not going to make up the actual earnings numbers if they're not sitting here. Business-wise, this is not AI, not biotech. It's kitchen and bath products, fixtures, vanities, cabinetry, that kind of consumer cyclical name. But here's the risk tab, and this is why the markets desk treats these rips carefully. Active shelf, active equity line, medium dilution risk, and roughly $1.1 million listed as raisable. So the chart is hot, yes, the cap table still matters. Back to the tape. The levels are simple. Above 940, this base can try to retest that 970-day high. That's the momentum trigger I'm logging. Under 840, the character changes, because that's where buyers defended the pullback multiple times. So for FGI, big breakout, confirmed volume, tiny float, now sitting in the 930 base. Great chart to watch, dangerous chart to chase. If volume dries up, these can unwind just as fast as they squeeze.
Thanks, Markets Desk. All right, quick macro check because this tape is quiet but not asleep. SPY sitting at 773.78, up 0.17%. QQQ basically flat at 723.72, and IWM's up 0.16% at 303.18. So, the market's not throwing a parade here. It's more like it showed up early, got coffee, and is waiting for the 12:30 PPI print. VIX is 19.42, down just 0.15%, and that matters. Under 20, the risk thermostat is warm, not boiling. But QQQ's been boxed in tight. Low around 722.80, high around 724.78. Current area, basically 724. That's the whole story for tech right now. No panic, no real breakout, just a very polite argument between buyers and sellers in a $2 box. Now the cross-asset tell is actually cleaner than the index tape. Bond proxies are bid. TLT at 82.33, up 0.27%. IEF at 93.12, up 0.17%. So yields are leaning softer through that lens, even though we don't have a clean 10-year yield level on this feed. Oil's the bigger macro clue. USO at 125.07, down 1.75%. When energy cools, the inflation pressure story takes a little air out of the balloon. Gold's lower too. GLD 402.98, down 0.48%. So the safe haven/inflation hedge bid is not exactly pounding the table. Crypto proxies are modestly green. BITO up 0.35%, Coin up 0.19%, MSTR up 0.6%. So risk appetite is there, but it's wearing a seatbelt. Also, the dollar line on the portal is printing 0. So I'm not going to pretend the dollar went to 0 overnight. That would be a bigger show and probably fewer coffee jokes. Yeah, so the rate side is still the tell for me here. TLT's green at 82.33, IEF's green at 93.12. Nothing crazy, but that's yields leaning softer, and that matters for NASDAQ risk. If yields are easing while QQQ is just chopping, that gives the growth trade a little breathing room. Not a green light, just one less headwind. Yen proxy's also a tiny bit firmer at 57.56, so you've got a mild safety bid in a couple spots. Dollar feed, though, I'm throwing out for now. It's printing a 0 and negative 100% on the dashboard, so I'm not building a takeoff bad data. Now flip back to QQQ. This is the range. Upper shelf is basically 724.70 to 724.78. Support is 723, and the day low is 722.80. If QQQ can get above 724.70 and actually hold there, then the quiet tape gets a little more constructive. If it loses 723 and can't reclaim, then the chop starts leaning lower. And the clock matters. 12:30 Eastern, PPI and jobless claims hit the tape, plus Fed speakers after that, so reaction over prediction. VIX is still under 20 at 1942. That 20 line is the mood switch. All right, that's the macro map. Quiet tape, tight levels, big clock ahead. Let's hand it back to the tape and see where the movers are waking up. All right, quick macro check. The tape looks quiet, but the cross-asset board is doing that little whisper before it yells routine. SPY sitting around 773.5, up 0.13%. QQQ's basically flat to red at 723.2, down 0.07%. IWM's up 0.09%, so small caps are not exactly panicking, and VIX is down a hair at 19.40. That's the important part. Vol is not confirming stress right now. The market's desk has been living in those low float movers. Fair, that's where the fireworks are. But here at the macro desk, the index story is more like a waiting room with CNBC on mute. Bonds are a little better bid too. TLT up 0.27%. IEF up 0.17%. So you've got equities mixed, volatility soft, and duration catching a bid. That's not a fear trade yet. That's the market saying, cool, we'll wait for the inflation number before doing anything dramatic. Very adult behavior from a market that usually eats crayons at 8:32 in the morning.
Thanks, Macro Desk. Let's pull up XHG, because this one just jumped onto the tape. Okay, look at this thing. Market's basically mixed. SPY green by a hair, QQQ flat. And XHG is showing up huge on the movers board, around 70% on the board with monster relative volume. The 1-minute read is wild. Early trade was sleepy, 92 cents to 98 cents. Tiny bars, basically nothing happening. Then bang, volume hits. We get that expansion from the low 90-cent area, straight through a buck, and the chart tags the 138 zone in the candle package. Oof, look at that ramp. That's not a grind, that's a parabolic burst. Current read is holding elevated. Last candle stalling near the highs around 136 in the analysis, while the board print is around 156. So pre-market prints are moving fast here. Now catalyst check. Because with these little names, you need the headline or this is just pure flow. The Fresh Company press release says Exchange Tech intends to acquire First Cycle, pitching it as an AI-powered insurance transformation deal. So that's the story traders are latching onto. Insurance, SaaS angle, AI language, tiny market cap. Reported shares outstanding are under 1 million, and the datasets float is basically microscopic. That's exactly why the candles look like this. A few aggressive prints can move the whole thing fast. Fun to watch, dangerous to chase blindly. Here's the risk side, and I'm not burying it. XHG has high dilution risk in the platform. Active shelf, active equity line, 6 active shelf items, and over 100 million raised in the last 12 months. So at the markets desk, the read is simple. The tape is hot. The headline gave it fuel, but the structure is fragile. I'm watching 130 as the first momentum shelf now. If that cracks, the spike starts to look tired. Below 110, that's the deeper support from the candle read, and the whole move changes character. If it keeps holding above the prior spike zone, fine, momentum is still alive. But this is absolutely small cap volatility tape, not a clean blue chip setup. Coming up, we've got the macro report window on deck.
Thanks, Markets Desk. Quick macro pulse before the next data landmine hits the tape. Here at the macro desk, the story is not exactly fireworks yet. It's more like everybody's standing around the microwave, waiting for PPI. SPY is sitting around 773.8, up about 0.17%. QQQ basically flat at 723.6. Russell slightly green at 303.4. And VIX is still behaving at 19.37, down a touch. That tells you the equity tape is calm, but not relaxed. Big difference. On SPY, the range is tight. 773.35 is the low sideline, 774.50 is the lid. Until one of those breaks with some intent, this is a market marking time, not making a statement. The more interesting stuff is outside the stock screen, which is usually where macro hides the keys. Bond proxies have a bid. TLT at 82.29, up 0.22%, and IEF at 93.09, up 0.14%. That's the market saying, all right, maybe yields don't need to punch everyone in the face before breakfast. Oil is down 1.86% to 124.93. Gold is off 0.64% at 402.33, and the yen proxy is a little firmer at 57.60. So the chain is pretty clean. Less energy pressure takes a little inflation heat off. Gold loses some safety bid. Bonds catch a modest bid, and that gives Nasdaq just enough oxygen to not roll over, even though QQQ is not exactly doing cartwheels here. Crypto's mixed, but still alive. BITO up 0.35%, MSTR up 0.42%, coin slightly red. That's not a risk on parade. That's risk appetite with one hand still on the emergency brake.
I've been digging into the July inflation setup, the labor data, oil, and the AI earnings backdrop. And the short version is this: the market has enough good news to stay interested, but not enough clean evidence to declare victory. Headline inflation is cooling. Producer prices look calmer on the surface. CPI is moving in the right direction. Oil has backed off from the recent pressure zone. And jobless claims are still low enough to say we're not seeing a major layoff cycle. But the catch is core inflation. That is still the part of the story that keeps the Fed patient. And on the equity side, the rally is still leaning very heavily on AI leadership, especially semis, with Nvidia basically acting as the market's confidence anchor. Let's start with PPI, because producer inflation is usually where people look for early signs of pipeline pressure. The research read here is that July headline PPI was unchanged, while the year-over-year figure was still around 4.7%. That combination needs checking against the official release, because the monthly and annual framing can sometimes come from different series or seasonal adjustments. But the directional point is important. Headline pressure may be easing, while underlying costs are not collapsing. Core PPI, excluding food, energy, and trade services, reportedly rose 0.4% month-over-month and 4.7% year-over-year. If that is accurate, that is not a soft core number. That says companies may still be dealing with sticky input costs, even if energy is helping on the surface. Now CPI is a little more friendly to the disinflation argument. The summary has July CPI up 0.1% month-over-month and 3.4% year-over-year, with core CPI up 0.2% monthly and 2.5% annually. I'd want to verify that core annual figure, because depending on which inflation measure people are referencing, core CPI and core PCE can get mixed in conversation. But the message is still pretty clear. Inflation is cooling, not gone. That matters for the Fed. A softer headline number gives policymakers room to avoid sounding overly hawkish. But sticky core categories argue against aggressive easing. So for markets, the sweet spot is not necessarily cuts tomorrow. It is confidence that the next inflation surprise is less likely to be a bad one. The labor market piece is also important, because inflation alone does not drive the policy read. Weekly jobless claims came in around 209,000, up slightly, but still low by historical standards. That does not scream recession. What it suggests is more subtle. Companies may be slowing hiring, becoming more careful, and managing headcount through attrition rather than widespread cuts. That is a very different market signal from claims suddenly pushing towards stress levels. But there is a risk here. If payrolls are weak, participation softens, and claims start drifting higher together, then investors would probably stop calling it a soft landing and start pricing a harder slowdown. For now, though, the labor data looks cooler, not broken. Oil is helping the macro story at the margin. The research has WTI around 81.50 and Brent around 87.18, down from more uncomfortable levels. Lower crude helps in a few ways. It eases gasoline pressure for consumers, helps transportation and industrial margins, and reduces the risk that headline inflation reaccelerates just because energy spikes. But this is not a clean disinflation guarantee. Oil is still high enough to matter, and geopolitical risk around the Middle East means the market cannot fully ignore supply disruption risk. So I would frame oil as a near-term tailwind, not a solved problem. If crude keeps easing, that supports the soft landing narrative. If it snaps back, inflation expectations can move quickly. Now bring that macro backdrop into equities, and this is where NVIDIA comes in. On the platform here, NVIDIA is trading around $223, with a market cap near $5.4 trillion, a trailing PE a little above 55, and it is sitting not far from a year high around 236.54. That tells you a lot. This is not a hidden story. The market already understands that NVIDIA is the core beneficiary of the AI infrastructure build-out. The company's data center exposure, networking assets, accelerator demand, and software ecosystem are why it remains the benchmark. But at this valuation, good is not always good enough. The market is paying for continued execution, margin strength, and visibility. The recent NVIDIA news flow also shows how powerful the narrative is. There are headlines focused on record results, strong guidance, and the idea that the concentration bear case has weakened. One article excerpt on the platform references fiscal Q1 revenue of $81.6 billion, up 85% year over year, net income up more than 200%, and gross margin near 75%, with data center growth driving the story. Those are massive numbers. But the market question is not just whether NVIDIA is strong. It is whether the rate of upside can keep clearing a very high bar. When a stock becomes the liquidity center for an entire theme, it can support indexes, but it can also make market breadth look better than it really is. That is why the broader AI earnings read matters. NVIDIA, Supermicro, and CoreWeave have been treated as direct infrastructure winners. The market wants to see orders, capacity, backlog, and customer demand all pointing the same direction. But Cisco is a useful warning sign. The research notes that Cisco declined despite strong results. And that is exactly the kind of selectivity that shows up late in a powerful theme. Investors stop rewarding generic AI exposure and start asking, where is the revenue? What are the margins? Is growth accelerating? And is guidance strong enough? That does not kill the AI trade, but it raises the quality threshold. The easy phase is when everything with AI exposure moves. The harder phase is when only the cleanest stories keep working. Applied Materials is the next important checkpoint because it sits one layer deeper in the AI supply chain. If AI demand is real and durable, it should not only show up in GPU vendors. It should also show up in semiconductor equipment, advanced packaging, memory investment, foundry demand, and capacity planning. AMAT earnings can help answer whether spending is broadening or staying concentrated in a narrower group of winners. That distinction matters for market breadth. A strong NVIDIA print is one thing. A strong equipment cycle is a wider signal. But I would be careful assuming every part of the chain benefits equally. Export controls, China exposure, memory cycles, and customer timing can all complicate the story. even if the long-term AI capex theme remains intact. The Asian semiconductor rally adds another layer. Samsung and SK Hynix moving well would fit with the idea that AI infrastructure demand is spilling into high-bandwidth memory and the wider supply chain. That is constructive because the AI build-out needs more than just accelerators. It needs memory, networking, storage, power, cooling, and manufacturing equipment. But rapid semiconductor gains can also reflect positioning. Sometimes a move that looks fundamental is partly short covering, momentum chasing, or investors crowding into the same macro plus AI trade. That does not make it invalid. It just means follow-through matters. I would want to see breadth across semis, stable yields, and earnings revisions moving higher. So here is the full market read. The macro data is good enough to keep the soft landing argument alive. CPI is cooling, PPI is not flashing a new headline shock. Oil has backed off, and jobless claims are still low. But the parts that need verification and caution are important. Core inflation is still the key constraint. The Fed does not need to panic cut if labor is only slowing. And if core prices stay sticky, the market may have to live with higher for longer rates longer than it wants. On the equity side, AI earnings remain the engine, with Nvidia still the central name. But valuations are demanding. Nvidia's PE above 55 and its proximity to the highs tell us expectations are already elevated. That makes breadth the key tell. If AMAT, memory names, infrastructure suppliers, and non-megacap sectors participate, the rally looks healthier. If it is only a handful of AI leaders holding the tape together, then the index can look strong, while the average stock is more fragile. My bottom line, this is a constructive but selective backdrop. I'd be watching official inflation revisions, claims trends, crude oil, 10-year yields, and whether AI earnings keep broadening beyond the obvious winners. I've been digging into the morning setup, and the key thing is that this is not a clean macro day, and it is not a clean earnings day either. We've got July PPI giving the market two different stories at once. Headline producer inflation came in flat month over month, which is the number bulls can point to. But the underlying measure, excluding food, energy, and trade services, rose 0.4. And that 12-month pace is still sitting around 4.7%. So the market can't just say inflation is gone. At the same time, jobless claims ticked up modestly to 209,000, while continuing claims came down. That says labor is cooling, but not cracking. Against that mixed backdrop, the real action is selective. XHG and FGI are the two momentum names with pre-market long signals, but both need confirmation, not blind chasing. Starting with XHG, because this is the more extreme one on the screen. The platform profile shows Exchange TEC, listed on NASDAQ, operating out of China, with a business description tied to insurance agency services and a SaaS platform. The stock is around the low $1 area on the platform data, and the move is showing roughly 20% here, while the research signal references a much larger pre-market expansion. That difference itself is something I'd want to verify live against the tape, because small-cap pre-market percentage moves can vary depending on the timestamp and data source. What stands out more than the percentage is the structure. Market cap just over $1 million, average volume only about 14,000 shares, and a reported float of just 415 shares. That float number is so tiny that it needs cross-checking before treating it as gospel. That reported XHG float is the whole reason I would slow down here. If the tradable supply is genuinely that constrained, then yes, the stock can move violently on very little demand. But the flip side is just as important. It can reverse violently too. Tiny float names often have spreads that widen, liquidity pockets that disappear, and halt risk if the price starts whipping around. Another issue, the platform is not showing recent news for XHG. So if this move is not tied to a fresh filing, a press release, an analyst item, or a corporate catalyst, then we have to treat it as a momentum and liquidity event first, not a fundamental repricing. That doesn't mean the move is meaningless. It means the burden of proof is on price, volume, VWAP behavior, and whether buyers keep supporting pullbacks after the open. For XHG specifically, the cleaner way to think about the open is not, it's up huge, therefore it keeps going. The cleaner question is, where is the pre-market high? Where is VWAP? And does volume expand or contract during the first 5 to 15 minutes? If it opens strong but immediately loses VWAP, that tells me the pre-market move may have been mostly thin liquidity. If it dips, holds above a logical support zone, and then reclaims VWAP with volume, that is a very different tape. I'd also be watching whether it can hold above the $1 area, because sub-dollar and near-dollar names often attract very different types of participation. With a name like this, the level matters, but the speed matters more. A slow, controlled consolidation is healthier than a vertical candle followed by no bids. Now, let's shift to FGI. This one is different because the signal is reportedly tied to earnings and exceptional volume, with a pre-market move around 24%. That is more straightforward as a potential catalyst than XHG, assuming the earnings report checks out. But earnings momentum still has its own traps. A stock can beat numbers and sell off if expectations were too high. It can guide well and still fade if the move was crowded. It can spike pre-market and then spend the cash session digesting. So for FGI, I'm not just interested in the headline reaction. I'm interested in whether the market keeps rewarding the report after regular liquidity comes in. That means watching the opening range, whether buyers defend the first pullback, and whether the volume is real relative to the stock's normal baseline. The earnings reaction checklist on FGI is pretty simple. First, did the company beat on the line items the market actually cares about, not just one adjusted metric? Second, was guidance raised, reaffirmed, or vague? Third, is the balance sheet clean enough that traders are not immediately worried about financing or dilution? Fourth, is the float structure supportive or dangerous? And fifth, does the move hold when the broader market starts reacting to yields and macro data? A lot of small and mid-cap earnings movers look great at 8:30 or 9 o'clock in the morning. Then the real market opens and the first wave of sellers tests the bid. If FGI can absorb that selling while staying above key intraday reference points, the signal has more credibility. If not, the earnings catalyst may already be spent. Zooming back out to the macro piece, PPI is the tension point. The headline being flat month over month gives the market permission to breathe a little. It can support the idea that goods inflation and some producer-level pressures are not accelerating aggressively. But the cleaner core style measure, excluding food, energy, and trade services, being up 0.4%, is not exactly a victory lap. That is the kind of number that can keep Treasury yields sensitive, especially if traders start thinking inflation is sticky beneath the surface. So I'm watching whether the equity market focuses on the headline or the underlying detail. If yields stay controlled, high beta and small cap names usually get a better shot at follow-through. If yields start lifting, the market can get much more selective, and these pre-market momentum names become more vulnerable to sudden risk-off rotations. The jobless claims number adds another layer. Initial claims at 209,000 are slightly higher, but not alarming. Continuing claims moving lower complicates the story because it suggests people are not necessarily staying unemployed longer in a way that screams labor market stress. So this is still a gradual cooling narrative, not a collapse narrative. For equities, that can be supportive if investors see it as soft landing-ish, but it is not weak enough to automatically force a dovish policy interpretation. That's why I don't want to overstate the macro edge this morning. The data gives both sides something to argue. Bulls can say inflation headline is calm and labor is cooling. Bears can say underlying inflation is sticky and the labor market is still too firm. The tape, breadth, and yields will tell us which argument wins the open. On the earnings side, the reactions are really uneven, and that matters for sentiment. CSCO is a good example of why headline results are never the whole story. The company can report strong numbers and still trade down if investors were positioned for more. If guidance does not clear the bar, or if the stock had already priced in the good news. So when I see CSCO down despite strong results, I read that as a reminder that this market is grading companies against expectations, not against absolute quality. NFLX is the opposite type of reaction today, with the stock up around a major stake disclosure. That is not the same as an operating earnings beat, but it can still change sentiment because it signals outside institutional confidence. Different catalysts, different quality, different durability. There are also plenty of other earnings and reaction names in the mix. Lund R, JD, TPR, Burke, Yeti, SSYS, AIT, and AMAT. I'm not going to force a thesis on each one without the full reports in front of us, but the point is breadth of reaction. Are winners being rewarded cleanly? Are misses being punished harshly? Are good reports fading? That tells us whether the market has appetite for risk or whether it is using strength to take profits. AMAT is especially worth mentioning from a volatility standpoint because options around earnings can disappoint even when the directional idea is right. Implied volatility can be elevated into a print, and after the event, that premium can collapse. So for earnings names broadly, direction and realized move both matter. A correct narrative does not always equal a clean trade outcome.
Thanks, Company Desk. All right, Markets Desk, straight to the movers board. This tape is not exactly screaming risk on. SPY up 0.2, QQQ barely green, breadth mixed. So when a row is doing triple-digit nonsense, it matters. Top of the board, XHG up about 444%, 22 million shares, relative volume over 1,500 times. That's not a nice move. That's an auction gone wild. Right under it, FGI still at 92%, GXAI up about 52% with 37 million traded, and ARX up 45% on the deal headline. Then flip the board. FGL, LESL, CBRG, CLBT, VBIO. Ugly gaps, some with real volume, some just pre-market air pockets. We're not marrying any of this. We're reading velocity. Pull up XHG first. Oof, look at the scale here. $5 area from a name that has gone completely vertical pre-market. The board has it around 498, up 444%. And the wild part is the relative volume, 1,537 times normal. That's why it owns the top row. But here at the Markets Desk, this is exactly where we get picky. Reported float is tiny, 415 shares on the data feed, market cap just over 1 million, and dilution risk is marked high. So yeah, it's ripping, but this is not a clean blue chip breakout. This can vacuum up and it can vacuum down. The obvious battle line now is $5. If it actually builds above 5 with volume, that's the squeeze pressure line. If it keeps poking 5 and rejecting, those wicks matter fast. For me, this is a level scoreboard chart, not a victory lap.
Thanks, Markets Desk. Top of the hour, quick market minute for anyone just jumping in. It's 9:01 a.m. Eastern, and the tape is green, but not exactly throwing confetti. SPY 774.4, up 0.25%. QQQ 724.6, up about 0.1%. IWM 303.6, up 0.28%. VIX sitting 19.44, basically flat. Breadth is mixed, so this is not a broad stampede. It's more like the market found a decent chair in the waiting room. The big driver is still the 1230 PPI and jobless claims window, with Fed speakers around it, so the whole board is trading like it's trying not to make eye contact with the data yet. Cross-asset, the story is pretty clean. Bonds have a modest bid. TLT 8233, up 0.27%. IEF 9320, up 0.26%. And that's helping keep equity risk steady. Oil is the loud red tile, 124.76, down 2%, with the crude inventory story pressuring energy. Gold on the tape is 403.28. down 0.41%, so the safety trade isn't exactly pounding the table either. Yen proxy is firmer at 57.62, up 0.17%, and crypto-linked risk is slightly green. BITO up 0.47%, Coin up 0.31%, MSTR up 0.65%. Here at the macro desk, I'm watching SPY 77450, TLT 8230, Oil 125, and that 1230 data reaction. Coming up, we've got Mega Cap Watch, then back to the movers board, then a limb deep dive.
Thanks, Macro Desk. Let's pull up CBRS because this AI infrastructure name is getting hit while the index tape is actually greenish. Daily chart first. This thing had finally started to clean up. Long slide from the 350s down toward 160, then a base in that 170 to 220 zone, then the breakout attempt into 262. Volume backed that bounce too, so it wasn't just dead cat fluff. But here's the problem. Live print is around 217 and change, down about 16%. So that old 230 to 240 breakout shelf, that's not support right now. That's overhead. Oof. Failed breakout energy and the buyers can actually reclaim it. All right, let's drop down to the 1 minute. This is where the tape gets way cleaner. Early move was strong. Opens around 216.5. Buyers step in fast. Then you get that volume burst. Over 34,000 shares around the push through 218. And it runs to 222.95. That's the clean momentum high. Then it stalls. Range between roughly 218 and 222. Volume dries up. And then, oof, look at that late break under 218. Almost 20,000 shares on the sell push into 216.25. That's real supply showing up. Current area is around 217.4, so it's below the middle of the morning range. For the markets desk, 222.95 above is the momentum reclaim. 216.25 below is the trapdoor. In between, Chop City. Now hit the news, because the headline itself is not ugly on the surface. Cerebras says the fast inference cloud business nearly quadrupled in Q2. GAAP cloud revenue up 281%. Core cloud revenue up 287%. They're talking 600 megawatts of data center capacity under contract. OpenAI launch partner language for GPT 5.6, plus AMD and AWS partnerships. So yeah, big AI growth words everywhere. But the stock is still down 16% while SPY and QQQ are slightly green. That tells you the market is not just grading the headline. It's grading expectations, valuation, and how much of this was already priced. Also, there are securities investigation law firm notices on the feed. I wouldn't call those the main driver, but they add noise to an already heavy tape. Back to the chart for the scorecard. If CBRS loses 216.25 with volume, sellers are still in control, and that early ramp was just a squeeze into supply. If it reclaims 222.95, okay, buyers at least erase the pullback. Bigger picture, 230 is the first real overhead reclaim, because that's the lower edge of the daily breakout shelf that just got smashed. This is not a chase setup read, it's a tape tell. AI infrastructure can have monster growth and still trade heavy if expectations are too hot. Coming up, we're going right back to the movers board, because the small cap squeeze tape is still completely wild.
I've been digging into SPCX, and the setup is a really interesting mix of momentum, fundamentals, and some very aggressive spending assumptions. On the screen here, the first thing to anchor on is the current quote, about $145.68, which puts it back above the $135 IPO price. That matters psychologically because this name had early volatility, then a major insider share unlock, and the market still managed to reclaim that IPO level. But I don't want to frame this as just a simple rebound story. The bigger question is whether the market is rewarding real operating progress, or whether investors are looking past a massive capital spending cycle, because they believe SpaceX can become both a space infrastructure company and an AI infrastructure company at the same time. The overview gives us the core business mix, and it is broader than just rockets. You've got launch services with Falcon 9, Falcon Heavy, Dragon, and Starship development. You've got Starlink broadband for consumer and commercial connectivity, and then Starshield, which is the government and national security satellite layer. That business mix is why the market gives this company a very different multiple from a traditional aerospace contractor. It is part industrials, part telecom infrastructure, part defense technology, and now increasingly part AI infrastructure story. The market cap shown here is roughly $1.92 trillion, so this is not being priced like an experimental venture anymore. This valuation already assumes very large-scale success, which means the hurdle for execution is extremely high. Now, the bull case starts with the revenue number. Q2 revenue reportedly grew 92% year over year to $7.81 billion, and that was ahead of analyst expectations. That is not a normal growth rate for a company of this scale. If you're looking for evidence that launch demand, Starlink adoption, and government-related satellite work are translating into actual top-line acceleration, that number supports the argument. But there is an important distinction. Revenue growth is not the same as self-funding growth. In a capital-intensive company, I want to know how much of that revenue turns into gross profit, operating cash flow, and ultimately free cash flow. The headline is excellent, but the cash conversion is the part that needs verification. The loss number is also worth parsing carefully. The company posted a $541 million loss, which was reportedly less than half of what analysts were modeling. That is a positive surprise, but it is still a loss. So the read is not everything is solved. The read is more nuanced. Losses appear to be better controlled than feared, while growth is stronger than expected. That combination can drive a stock higher, especially after an IPO reset. On a free cash flow is deeply negative, the income statement may not tell the whole story. One of the recent headlines even points to roughly $25 billion of free cash flow burn over 6 months. I'd want to verify that directly in the filings before leaning too hard either way. The most controversial part of the story is the AI spend. We're talking about $15.8 billion of AI-related spending in a single quarter, above estimates, with plans to build infrastructure around NVIDIA chips and a target of 10 gigawatts of computing capacity by 2027. Put that in context. Quarterly AI spending was more than double reported quarterly revenue. That is huge. It may make strategic sense if SpaceX is trying to turn Starlink, satellite data, autonomous operations, and compute infrastructure into one integrated platform. But from a market perspective, this is where the assumptions get aggressive. Power availability, chip supply, cooling, data center economics, customer demand, and return on capital all become critical variables. This is where I'd separate operating strength from narrative expansion. The launch and Starlink businesses are tangible. Rockets fly, satellites are deployed, subscribers can be counted, contracts can be measured, and backlog can convert into revenue. AI infrastructure is a different underwriting problem. If SpaceX can use AI to improve rocket manufacturing, satellite operations, defense analytics, autonomous systems, and network optimization, that could be powerful. But if the market starts valuing the company as if every dollar of AI capex will produce high-margin recurring revenue, that is a leap. The economics of AI compute are competitive, power-hungry, and potentially cyclical. The company may have an edge, but that edge needs proof in margins, contracts, and utilization. The backlog is another major support point. The research notes a $47.5 billion order backlog, alongside roughly $100 billion in cash and marketable securities. That cash number, if verified, gives the company a lot of room to fund Starship, Starlink expansion, AI infrastructure, and manufacturing capacity, without immediately depending on external capital. But backlog is not all created equal. I'd want to know the duration of those contracts, the margin profile, how much is government versus commercial, and whether any single customer is too large a contributor. One recent news item references a possible major customer concentration near 20% of revenue. If true, that matters, because concentrated revenue can make growth look smoother than the underlying demand base really is. Let's talk about the unlock. because that was one of the biggest market tests. The first major insider lockup expiration reportedly added more than 900 million shares to the market. Normally, that kind of supply event can pressure a newly public stock, especially one with a massive valuation and a founder-heavy ownership structure. But in this case, the shares rose instead of falling. That tells you there was enough demand to absorb the incremental supply, at least this time. Still, I would not treat one absorbed unlock as proof that future unlocks do not matter. Supply events can be path-dependent. They depend on price, sentiment, broader risk appetite, and whether insiders actually sell or simply become eligible to sell. On price action, the key marker is pretty simple. The stock is back above the $135 IPO price, sitting around $145, but still well below the displayed year high of $225.64 and above the year low of $104.83. That gives us a wide post-listing range. The reclaim of the IPO price is constructive because it changes the psychology from underwater IPO to rebound candidate, but it does not erase the volatility. In a name like this, levels can become very sentiment-driven. I'd be watching how it behaves around the IPO price if there's a pullback, and whether volume confirms institutional demand. The platform shows volume as 0 here, so I'd want live tape confirmation elsewhere before making any strong read on liquidity. The news flow around this stock is also very personality-driven because of Elon Musk's ownership and net worth headlines. We have stories here about the stock recovery, his potential trillionaire status, and comments around short sellers. Those headlines can pull attention into the name, but for valuation work, they are secondary. What matters more is whether SpaceX can turn Starlink subscribers into durable margins, whether launch cadence keeps scaling, whether Starship reduces cost per kilogram to orbit, and whether AI CapEx produces real revenue rather than just bigger depreciation and power bills. The media cycle can amplify the move, but the company eventually has to show that the spending is creating economic value, not just expanding the ambition. So my bottom line on SPCX is this: the company has real operating momentum, and the 92% revenue growth is hard to ignore. Beating revenue expectations while losing less money than expected explains why the stock could rebound above the IPO price even after a huge insider unlock. But the valuation is already enormous, and the AI spending is so large that it becomes the central debate. The next things I'd want to verify are free cash flow burn, backlog conversion, Starlink margin trends, customer concentration, Starship milestones, and the schedule for future unlocks. If those improve, the premium valuation has more support. If they deteriorate, the market may start questioning whether this is growth at any cost.
Thanks, Company Desk. Markets Desk is pulling up DFSC because this thing just went from sleepy to violent. We're on the 1 minute. Early tape was basically noise. 127 open, choppy around 122 to 135. No real trend. Then boom, candle opens around 153. Volume absolutely detonates, and it rips to 214, then tags 217. That's not a normal grind. That's a parabolic pop. Market's only modestly green. SPY and QQQ up a couple tenths, and DFSC is ripping over 50% on the movers board. So yeah, relative momentum is real here. But oof, look at the give back. Big wick, sharp fade, now trying to hold that 180 to 190 zone. Here's the tactical read. The high is 217, that's the boss level now. Until DFSC can reclaim that area with actual volume, that spike is still supply. Underneath, 1.80 is the line I care about, not because it's magic. Because after the flush from the high, that's where buyers started trying to build a base. If 1.80 starts cracking, the character changes fast, and this can turn into a full round-trip trap. Float is tiny, about 1.35 million on the overview, so every candle gets exaggerated. That's why these can look amazing for 3 minutes and then punish late chasers immediately. For the markets desk, clean setup is simple. 1.80 holds, 1.90 keeps firming, maybe it tries to rebuild. Lose 1.80, I stop calling it consolidation and start calling it distribution. Now the catalyst check. News tab has the morning headline, DefSec announced third quarter fiscal 2026 results. Defense tech name, tactical systems, counter-threat stuff. That theme can absolutely catch a pre-market bid when the float is this small. But I'm also checking dilution, because small cap runners live and die there. The dilution page has DFSC marked medium risk, no active shelf, no active equity line, no pending S1 showing here. But runway is only about 4.5 months, and cash need score is elevated. Plus there was a CAD 2.5 million registered direct in June in the recent press stream. So the read is, real volume, real spike, but still a tiny float, high volatility chart. Watch 2.17 above, watch 180 below. Coming up, we'll keep rotating the movers board and see if this one actually holds that base. Alright, let's hit the movers board and sort out what's actually alive right now. Tape is green but not clean. SPY up about 0.3. QQQ up a little under 0.2. IWM slightly better. VIX still hanging around 1940. So if a name is up 40, 80, 500% in that backdrop, that's its own thing. Top of the board is still XHG. Oof, 570 up 520 plus with 32 million shares. Relative volume over 2,000 times. Then FGI holding the number 2 slot around 886, up 87%. DFSC, the one we just had up, still up 84. GXAI is hanging in at 133, and ARX is the bigger, cleaner financial services mover at 1965. Markets Desk version, first question is not what's the story, it's where did volume actually hold. Board first, charts next. XHG first, because this thing is still the scoreboard monster. We already had that $5 level get tagged. That call out hit at 909, and now the question is acceptance, not just a headline print. Price is sitting around 570. Reported float on the board is basically microscopic, so the candles can look fake both ways. Huge green push, then one ugly red bar can erase $1. That's the danger. On the 1 minute, I'm watching the 5 area as the character line now. If it keeps holding above there, bulls can argue the reclaim is real. If it loses 5 and can't snap back, that's the first sign the squeeze is turning into a liquidity trap. Above $6 is the clean psychological test. Not a target, just the next spot where the offer can show up. This is the kind of runner where the level matters more than the story.
Thanks. Markets Desk. All right, Macro Desk taking the wheel for the opening bell countdown, and we're about 10 minutes out from the part of the morning where everyone pretends they're calm. Here's the setup. SPY sitting around 774.8, up 0.3. QQQ around 725, up about 0.2, and IWM is actually a touch better, up roughly 1/3%. So the surface read is risk on, but not a confetti cannon. Breadth is still mixed. VIX is 19.39, down a hair, and that matters because 20 is still the mood line. Under 20, the tape can breathe. Back over 20, suddenly everyone remembers they have risk managers. The bigger clue is bonds. TLT at 82.57, up 0.56%. IEF at 93.30, up 0.37%. That's the bond market quietly saying, hey equity folks, rates are not punching you in the face right this second. And for mega cap tech, especially the AI names, that rate relief is the denominator. NVIDIA is basically the mood ring for the AI train today, with the financing consortium headline in the background. But the real macro fool is whether bonds stay bid after the cash open. Now the cross-asset story is pretty clean into the bell. Oil is the big pressure valve. USO is down 2.11% at 124.62, and we had that 125 line flagged earlier. It broke lower, so the inflation panic premium is bleeding out a bit. That helps the soft landing crowd, at least for the first cup of coffee. Gold is not confirming a big fear bid either. GLD 402.92, down about 0.5%. Yen is firmer. FXY 57.64, up 0.21%. So even if you only trade US stocks, keep one eye on yen and bonds here. Those two can change the entire temperature of the room. Dollar feed on this portal is not clean, so we're not doing the classic macro sin of building a thesis on a broken number. Crypto proxies are a little green too. BITO up 0.58%, Coin up 0.31%, NSTR up 0.55%, which fits the same lower vol, lower oil, risk and breathe setup. Into the open, here's what I'm watching. SPY staying above 774.50, VIX staying under 20, USO staying below 125, and TLT holding above 82.30. Then the real scheduled landmine is later. PPI and jobless claims at 12:30 Eastern. PPI estimated at 0.2 month-over-month. Core PPI 0.3, jobless claims 202. But first things first, when the bell rings, I want to see whether the AI leaders, NVDA, CWVR, Light, NBIU, pull the tape, or whether the small cap fireworks from pre-market start stealing oxygen right out of the open.
Thanks, Macro Desk. Let's pull up LIMN, because this little biotech is loud but messy. All right, here's the tape. Movers board had it up about 35%, 14.5 cents, relative volume around 680 times. But oof, look at the structure. It spikes early into 20.4 cents. Heavy volume confirms the rip, and then it just cannot hold. Lower highs, lower lows, straight fade into the 13.6 area. Now it's trying to build a little base between 14 and 15 cents, but the volume's drying up. So here at the markets desk, the line is clean. 15 cents above is the reclaim. Below 13.6, that base is failing again. Now, quick catalyst check. This is Liminatus Pharma, clinical stage immuno-oncology, tiny market cap, and the fresh headlines are not a clean today morning catalyst. The recent stuff is June. Amended merger agreement with Inox AI, plus a warrant exercise for $1.9 million in gross proceeds. That matters because the dilution page is ugly for a 14-cent biotech. High dilution risk, active equity line, runway under 2 months on the data we have. So yeah, LIM can move. The tape already proved that, but this is not a clean strength chart yet. 15 cents reclaim, 13.6 fail. Coming up, we'll flip back to the movers board and keep score. All right, markets desk back on the movers board. Fast pass, no fluff. Tape's greenish but mixed. SPY up about 0.25%, QQQ barely green, IWM leading a touch. VIX still under 20. So if something on this board is up 50, 80, 500%, that's not the market doing it. That's stock-specific flow. Top of the board is XHG, up 539%. Oof, 33.9 million shares. Relative value over 2,000 times average, and the float listed here is tiny, 415 shares. That is not normal liquidity. That's air pocket territory. Then FGI still up 86, DFSC up 76, and yes, that DFSC 217 callout already hit. Nice one for the scoreboard. GXAI up 53, ARX up 44. On the red side, LESL and FGL are getting hit hard. We're going chart by chart now. Let's pull up XHG first, because this is the ridiculous one. 1 minute chart. Price is sitting around 585, up over 5 times on the session. And this is where the markets desk gets very careful. We already had the $5 reclaim on the scoreboard earlier. That hit. And now the open flags are simple. 5 below is the trapdoor, 6 above is the squeeze test. Right here, anything between 5 and 6 can get nasty both ways, because the volume is huge. The listed float is microscopic, and dilution risk on the board is high. So I'm not hyping this. I'm watching whether buyers can actually hold above that $5 character line, or whether the move starts wicking into 6 and rejecting. If it punches 6 with clean 1 minute volume, okay, that tells you momentum is still alive. If it loses 5 after this kind of run, that's where these names can go from monster gainer to liquidity trap real fast. FGI next. And this one's a cleaner squeeze read than XHG, but still tiny float chaos. We're talking roughly 520,000 shares in the float, 32 million shares already traded, almost 100 times relative volume. So yeah, this is not normal flow. Price is around 880, which puts it just under that $9 reclaim zone. That's the whole game for me on this one. Can buyers actually own 9, or is 9 just where the bag of supply keeps showing up? If it keeps making lower highs under 9, that's a fade look. If it reclaims 9 and holds above it for a few candles, then the squeeze is still alive. I'd also keep an eye underneath. If it starts losing the mid-8s, that's where the character changes fast. Now, DFSC. This is the one where that 217 level actually mattered. We flagged it, it hit, and now the board's got it sitting around 219, so it's still hovering right above that spot instead of fully blowing through it. That's useful. But the bigger warning is still 230. I don't want to rehash the whole spike. We already covered that. The update is simple. Under 230, sellers are still getting chances to lean on it. Over 230, different conversation, because then the fade warning starts getting invalidated. Volume's real here too. 17 million shares, about 30 times relative volume. So this isn't dead, it's just in that awkward middle, where you've got bulls trying to defend the prior level and shorts watching every lower high. GXAI now. This is the AI/gaming momentum name, and it's not small volume, it's wild volume. Board has it around $1.34, up about 54%, with almost 39 million shares traded, and relative volume north of 240 times. So yeah, that's real attention. The issue is structure. It's still under that 150 area, and that's where I'd want to see whether buyers can actually absorb supply, or if it just turns into another pop and fade microcap move. Underneath, 130 is the line I don't want to see it keep losing if you're judging momentum. Above 150, different conversation. Below 130, the tape starts looking a lot more tired. Also, high dilution risk on this one, so I'm not treating the headline move like it's clean just because the percent is huge. ARX is a totally different flavor. This is not the 500 share float nonsense. Financial services, insurance brokers, 2.2 billion-ish market cap, and it's still up 44% on 18 million shares. Relative volume is about 15 times, so it's moving, but it's moving like an actual larger listed name instead of a slot machine. Around 1960 right now, the clean read is whether it can keep building toward that $20 area without giving back the prior push. If this holds near the highs, while the broader tape is only mildly green, that relative strength matters. I'm not chasing it verbally here, I'm just saying this is the cleaner chart on the board, compared with the microcap chaos we just walked through. Alright, quick red board check before we wrap the scan. LESL first, and this is what relative weakness looks like when the tape's actually a little green. 1 minute chart, stocks around 79 cents, down 40%, and volume's only about 480,000. So this is not the same kind of upside panic volume we saw in XHG or GXAI. For me, this is simple. Below 80 cents, it's still heavy. If it reclaims 80 with actual volume, okay, maybe you get that dead cat bounce attempt. But until then, this is more capitulation tape than clean reversal tape. Now FTL, same red board vibe, but different liquidity profile. 47 cents, down about 39%, 5.4 million shares traded, but relative volume's only 0.38, so I'm not going to pretend that's huge demand showing up. 50 cents is the obvious psychological line here. Below it, sellers are still in control. Quick rotation to finish. LIMN is the penny biotech liquidity magnet. 15 cents, up 37%, 208 million shares, almost 700 times relative volume. So yes, it's active, but it's still a tiny biotech penny tape, and that can flip fast. CBRG is the shell company loser. 452, down 33%. Relative volume's massive versus normal, and those SPAC/shell names can get weird when liquidity disappears. And OFAL. Last one, industrial momentum. 180, up 32%. 26 million shares, 150 times relative volume. That's the cleaner momentum look of the last three, but same deal. I want to see whether it can hold that 180 area instead of just spiking and fading. Good movers scan. We hit the crazy gainers, the downside names, and the penny liquidity traps. Keep these levels on the board, and we'll roll straight into the next setup from here.
Thanks, Markets Desk. Quick news brief from the macro desk, and we're starting with inflation. July CPI came in exactly on forecast, up 3.4% year over year and 0.1% month over month. The reason this matters is simple. It did not hand the market a fresh inflation surprise to panic over. That's why you're seeing the tape hold a modest green tone here. SPY around 774.8, QQQ around 725.4, VIX still under 20 at 19.39. Not a victory parade. More like the market exhaling into a paper bag and realizing it can breathe. Next, big one. Nebius Group, ticker NBIU. Revenue exploded 454% year over year to $582 million in Q2. That is a monster top-line number, and it lands right in the middle of the AI infrastructure trade, cloud capacity, GPUs, enterprise demand, all the expensive plumbing behind the AI headlines. Why investors care? This keeps the AI spend story alive beyond just the mega-cap chip names. But here at the macro desk, the boring adult question is still profitability and capex. Revenue can sprint. Cash burn sometimes follows in a golf cart with no brakes. All right, the bell is live. Macro desk wide lens on the first few minutes. Cash markets open, the pre-market theater is over, and the first read is risk on, but not exactly fireworks. SPYs at 774.6, up 0.27%. QQQ's basically flat green at 724.4, up 0.09%. The Russell is the interesting one. IWM up 0.62% at 304.6, so small caps are grabbing the steering wheel early. VIX is down a hair at 19.40, bread is mixed, and I don't have a clean Dow print on this tape, so I'm anchoring the open off S&P, NASDAQ, and Russell. Out of the gate, the movers board is doing movers board things. XHG up over 500%, DFSC up 143%, FGI up 75%, GXAI up 45%, ARX up 44%. On the red side, FGL and LESL are both down around 37%, CLBT down 33%. So yeah, the index tape is calm, but under the hood, it's a blender with a lid that may or may not be attached. Here's the macro chain, because the open isn't just stocks blinking green on a screen. Bonds are bid again. TLT is up 0.60% at 82.60. IEF up 0.37% at 93.30. That's rate pressure easing at the margin, and when rates stop punching growth stocks in the face, NASDAQ gets room to breathe. Even if QQQ is only up 9 basis points right now. Oil is down 2.29% at 124.39. Gold is off 0.61% at 402.43. And the yen proxy is a little firmer, with FXY at 57.64. Translation: the panic premium is cooling, safe haven bid is fading a bit, and equities are allowed to act like adults for 5 minutes. Dollar feed looks busted on this tape, so I'm not using that as a signal. Crypto proxies are modestly green too. BITO up 0.35%, Coin up 0.17%, MSTR up 0.20%. Not a stampede, more like crypto poking its head out from under the desk and asking if the coast is clear. Now flip that macro read into the opening movers, because this is where the tape gets honest. I'm on the board here. Green side, XHG, DFSC, FGI, GXAI, ARX, those are the early strength names. Weak side, FGL, LESL, CLBT, those are getting hit. And that split matters because the Russell is the tell right now. IWM's up about 0.6, SPY's up about 1/4 point, QQQ's barely green. So yeah, tech isn't dead, but the better risk appetite is showing up underneath the mega cap layer. That's usually a healthier open than just one AI basket dragging the whole market around. Now for the radar. 12:30 Eastern, PPI and jobless claims. That's the next real macro punch. Fed speakers later, so don't fall asleep after the first move. On QQQ, I'm watching that 725.40 area. That was the morning high zone, and underneath, 724.50 already cracked on heavy volume. So 722.80 is the real lower marker from the early range. Bonds still bid. TLT 82.60, IEF 93.30. That's supportive if it holds. Oil's the opposite story, down over 2%, sitting around 124.40. If that 124 handle loses, energy and inflation reads get louder. VIX at 1940 is calmish, but if it reclaims 20, that changes the feel fast. Breadth is mixed, not a clean all-green rip, so stay tactical. All right, that's the macro map for the open. Let's hand it back to the live movers and see what's actually getting chased.
Thanks, Macro Desk. All right, Markets Desk is back on the movers board, and this thing is spicy right out of the gate. SPY's green, QQQ's green, IWM's leading a bit. VIX is basically flat under 20, so risk appetite is there, even with bread still kinda mixed. Top of the board, XHG, absolute monster, up 528%, 37 million shares already, relative volume over 2,600. That's not a normal morning print. Then DFSC still hanging around, up 143, FGI up 82, GXAI up 48, ARX up 44. Red side matters too. LESL down almost 40, FGL down 37, CLBT down 35. So yeah, we've got squeezes, earnings pops, and a couple of trapdoor charts. We're going one by one. Fast tape. Now, XHG first, because oof, this is the board leader by a mile. We're on the 1 minute. Current print is around 575, up over 500%. And the volume is the headline, 37.8 million shares traded versus an average volume around 14,000. That's a full liquidity event. The markets desk is not treating this like a normal chart. When something moves like this, the question is not, is it strong? Obviously it's strong. The question is, does the bid keep absorbing pullbacks, or does it turn into air pockets and wicks? First line I'm marking here is 550 below. If 550 starts failing on the 1 minute, that's where the character can flip from controlled squeeze to messy fade. Above it, buyers are still at least defending the upper part of the move. But spreads and halts can get nasty on a name like this, so I'm reading the tape, not cheering it. DFSC now, and this is the one I wanted right after XHG, because it's still wild, but it's a different flavor. Defense tech name, Aerospace and Defense Group. Current board print right around 302, up about 143%. Volume's already 22.8 million, against normal volume around 577,000. So yeah, the tape found it. The whole question is that $3 area. If this 1 minute keeps accepting above 3, that's buyers defending the new shelf after the squeeze. But if you start seeing repeated upper wicks and it loses 3 cleanly, that's where it can turn from momentum into bag holder candles pretty fast. Float's only about 1.35 million, market cap barely 6 million, so the candles can look ridiculous both ways. I'd keep the read super simple here. Above 3, still alive. Below 3, respect the rug pull risk.
Thanks, Markets Desk. Breaking macro hit here. Oil shock is feeding straight into rate expectations. Headline on ProTerminal: traders boost BOE and ECB rate hike bets after the oil price surge. What happened? Oil spiked overnight, and traders are now pricing more chance that the Bank of England and the European Central Bank have to stay tighter for longer. What we know, this is a commodity shock bleeding into rates. What we don't know yet, the exact size of that repricing, or whether the central banks actually validate it. Market read, live oil is 124.39, down 2.29% on the current quote. So there's some give back, but it's still sitting just above that 124 macro tripwire. Meanwhile, SPY's up about 0.5%, QQQ's up about 2/3. The equity tape is doing that classic, please don't make me care about inflation yet. Next card. Oil extends gains after fresh U.S. strikes. Stocks mostly rise. The fact pattern from the desk: oil moved higher after fresh U.S. military action, but equities have been resilient instead of puking risk. Why it matters? Energy is the tax that nobody votes on. Higher fuel costs can squeeze airlines, transports, manufacturers, and consumer-facing companies. And that's exactly why rate pricing starts twitching when crude gets loud. VIX is 19.46, basically flat. So this is not an equity panic tape right now. It's more like the bond market putting on the helmet, while stocks are still checking their hair in the mirror.
I've been digging into the July PPI print, and the cleanest way to frame it is this. Flat producer prices are good news, but not a victory lap. PPI being unchanged month over month tells us wholesale cost pressure, at least for that month, stopped accelerating. That matters because producer prices are the upstream part of the inflation pipeline. Before consumers see prices at the register, businesses first see costs in fuel, freight, packaging, commodities, labor-adjacent services, machinery, and supplier contracts. So when PPI cools, it can give companies some margin breathing room, and it can also give the Fed less reason to rush into another hike. But the reason I want XOM on the screen first is because energy is still the big caveat. If crude, Gasoline, diesel, or jet fuel reprice higher on Middle East risk, the whole margin relief story can get messier very quickly. The headline number was genuinely constructive. July PPI was unchanged on the month, and the annual pace slowed to 4.7% from 5.5%. That is not the Fed's 2% world yet, but directionally it is better. For the market, the first read is usually, okay, are input costs easing enough to protect earnings? If the answer is yes, then companies with cost pressure can stop playing defense. They do not necessarily need to raise prices as aggressively, and they may be able to defend gross margins if volumes are holding up. The second read is policy. If wholesale inflation is cooling, the Fed has less evidence that it needs to lean even harder. But I would not call this an all clear. A lower annual rate is still elevated, and a single flat month can be reversed if energy turns. Margins are the key connection here. PPI is not just a macro statistic, it runs straight through income statements. A retailer facing slower supplier price increases has a choice. Hold shelf prices steady and capture better margin. Cut prices to protect traffic, or some mix of both. A logistics company sees it in diesel and maintenance costs. An airline sees it in jet fuel. A manufacturer sees it in metals, components, freight, and energy. The bullish version of flat PPI is that costs stop rising faster than selling prices, so operating leverage improves. The less bullish version is that demand is softening enough that producers cannot raise prices anymore. That is why we have to separate good disinflation from weak demand disinflation. For markets, the best version is cooling costs without collapsing demand. For the Fed, this print gives them some breathing room, but it does not finish the job. The Fed does not target PPI directly. It cares about broader inflation, especially consumer prices, services, wages, and inflation expectations. But PPI can lead parts of CPI because companies either pass higher input costs forward or absorb them. If producer inflation cools for several months, it supports the case that pipeline pressure is fading. That can reduce pressure for a September hike, or at least make the committee more comfortable waiting for more data. But if energy spikes and services inflation stays sticky, the Fed can still stay hawkish. So the right read is not mission accomplished. It is more like one data point that lowers the temperature, pending confirmation. Now let's talk about why energy is such a big exception. Exxon is trading around 158 on the platform data with a market cap north of $650 billion. So this is not some niche inflation input. Integrated energy companies like XOM sit right at the intersection of crude, refining, chemicals, and transport fuels. The recent news flow here also points to strong cash generation, refining strength, and shareholder returns, which tells you these companies can do very well when commodity markets are supportive. But from an inflation standpoint, higher energy is a tax on almost everyone else. Gasoline hits consumers. Diesel hits freight. Jet fuel hits airlines. Natural gas and power costs hit utilities and industrial users. So energy strength can be equity positive for producers, while inflation negative for the broader economy. The Middle East angle is not about trying to predict every headline. It is about recognizing that the energy market has embedded geopolitical optionality. Conflict risk can affect crude through actual supply disruptions, but also through insurance costs, shipping routes, risk premiums, and refinery feedstock expectations. Even if barrels are not immediately taken offline, traders can bid in a risk premium when the probability of disruption rises. That matters because inflation data arrives with a lag. A flat July PPI might look clean, but if gasoline prices rose again in late July and early August, that can show up later. And energy does not stay neatly inside the energy category. It bleeds into freight rates, airline costs, plastics, chemicals, agricultural inputs, and consumer delivery costs. Airlines are one of the cleanest examples of this push and pull. So DAL is a useful screen here. Lower or stable fuel costs can be a major margin tailwind for airlines. because jet fuel is one of the biggest variable expenses. If fares hold up and fuel eases, margins can expand quickly. But the reverse is also true. If crude and refined products spike, airlines either absorb the hit or try to pass it on through fares. And that depends on demand. If consumers are already stretched, passing through higher fuel costs is not automatic. That is why a flat PPI can help the earnings setup for fuel-sensitive sectors, but only if the energy calm persists. The vulnerability is that fuel shocks can hit faster than pricing power can respond. Freight and logistics give us the next layer. FDX is exposed to fuel, labor, aircraft and vehicle maintenance, and the health of shipping demand. In a softer PPI environment, the company may benefit from slower cost growth, but freight is also a demand indicator. If PPI cools because supply chains normalized and input prices eased, that's constructive. If it cools because goods demand is rolling over, that's a different message. Diesel is especially important because it moves through trucking and ground delivery networks. Higher diesel can pressure carriers, but it can also show up as fuel surcharges for customers, which then becomes a cost for retailers and manufacturers. So the inflation chain is not instant, but it is connected. Retail is where the pass-through question gets really important. Walmart, Home Depot, and Lowe's are not all the same business, but they all care about supplier costs, freight, packaging, wages, and consumer sensitivity. If wholesale costs stop rising, retailers can rebuild margins after a period where they were forced to manage inventory markdowns and cost inflation at the same time. But competition matters. If shoppers are trading down, retailers may pass some savings back to customers through promotions, rather than keeping all of it. For HD and Low, watch building materials, lumber, metals, appliances, and housing activity. A cooler PPI is helpful, but home improvement also depends on rates, housing turnover, and consumer confidence. So margins may improve, but the revenue side still has to cooperate. For industrials and manufacturers, I would broaden the lens beyond fuel. Boeing, for example, is tied to complex supply chains, metals, components, labor availability, and aerospace demand. A flat PPI can suggest that some material and supplier inflation is easing, but it does not automatically solve bottlenecks or execution issues. This is where macro headlines can be too simplistic. Lower wholesale inflation helps if it lowers input costs and improves supplier stability. But if key categories remain tight, or if energy drives transport and component costs higher again, the relief is uneven. Manufacturers also tend to work through contracts, so the benefit can lag. The July print is a helpful signal, but company-level earnings calls are where we verify whether purchasing managers are actually seeing relief. So my bottom line is this. Flat July PPI is good news because it supports the soft landing version of the story. Cooling input costs, less pressure on margins, and less urgency for the Fed to tighten further. That can support earnings expectations, especially for companies where costs had been running ahead of pricing. But it is not an all clear because the annual PPI rate is still above the Fed's comfort zone. Services inflation can remain sticky, and energy is still exposed to Middle East-driven volatility. What I would verify next is pretty straightforward. Do August energy prices feed through? Do CPI and core services confirm the cooling? And do companies say on earnings calls that they are absorbing relief into margins or passing it through to consumers? That distinction matters for both stocks and inflation.
Thanks, Company Desk. Quick check from the Stock Whisperer. We're on the show's simulated paper trading portfolio, and the new piece here is PLTR. Long 35 shares, average price 174.87. Last showing 174.76, so basically flat to slightly red, down $3 and change. The setup was simple. PLTR cleared that 175 breakout trigger, while QQQ is still firm, up about 0.5%, but breadth is mixed, so I didn't want full-size risk. Smaller position, defined bracket, no chasing the headline. The line I'm watching now is the quality of the breakout. If PLTR can't stay constructive above that 175 zone and start slipping toward 172.50, that's the warning that the breakout is getting shaky. Here's the risk box. PLTR has the stop loss working at 169.80 and the take profit order sitting at 186.50. That's the bracket, that's the plan, and I'm not moving it just because one candle wiggles around. Rest of the book is steady. Ford is up about 18 bucks, NVDA up 44.50, QCOM up 21.54, Riot up 6.90, and the USO short is down 3.20 after that oil move got a little messy. Cash is still just under 48.9K, so we've got room, but I'm not forcing another trade while Brent is mixed. Watching NVDA above 228.50 for AI follow-through, and USO below 123.50 if the short starts working again.
Thanks, Stock Whisperer. All right, quick tool reset while this tape is still hot. This is the Pro Terminal Movers Board. Mixed breadth. QQQ up almost 1%. VIX still hanging near 19.5. So here at the markets desk, I'm not just asking what's green. I'm asking what's green with juice. XHG up over 400%. DFSC more than doubled. FGI still up 60 plus. That's the first filter. Not a buy button. A research starting line. Then, boom, one click and we're on the 1-minute chart. This is where the row either earns respect or gets exposed. Board says XHG is trading around 480, up huge with monster relative volume. Cool, but the chart tells you the real story. Where volume actually hit, whether bids are holding, whether it's clean continuation, or just a spike that everybody chases late. Oof, and that's why I like this workflow. The percentage move gets your attention, the candle tape keeps you honest. Now, flip to the part a lot of people skip. Dilution. Especially on small cap runners, this page matters. Shelves, ATMs, offerings, equity lines, that stuff can sit right over the tape. Pro Terminal pulls the dilution risk work into the same workflow, so you're not staring at a giant green candle with no idea what paper might be behind it. Data can be delayed, incomplete, or just not available on every name, sure. But even knowing where to check, huge. It turns the move from hype into homework. And then for a single name dig, I want the profile page, news, filings, insider activity, all in one spot. Pull up FGI, check the fresh headlines, flip the filings, then hit insider trades if you want more context. That's the whole idea. Movers, charts, dilution, filings, insiders. Same stack we're using live on stream. Educational only, no magic signals. If you want the dashboard yourself, go to proterminal.io. Coming up, we're right back to the movers scan.
All right, back to the movers board. Let's see what's still actually trading, not just sitting on a headline. Top of the board, XHG is still ridiculous. 480, up 424%, 40.8 million shares, relative volume over 2,800. That is not normal. That is a liquidity event. DFSC right behind it, 256, up 106%, 46 million shares, about 80 times normal.
FGI still up 71%, but that earlier downside alert already got tagged. So now it's a reclaim test, not a victory lap. LIMN, 15.9 cents, 274 million shares, biotech penny stock flow, super noisy. ARX is the cleaner adult in the room, 1950-ish, up 43%, NYSE, 2.2 billion market cap. Market backdrop helps a little. QQQ up almost 1%, SPY green, IWM green, but breadth is mixed. So here at the markets desk, I'm being picky. Let's pull up XHG first, because this is still the chaos leader. 1-minute chart. And yeah, this is why I don't love chasing the top print on a 400% mover. Price is around 480 right now, still green by more than 400%, and volume is 40 million plus versus a 14,000 share average. Relative volume over 2,800. That's insane. The board is also flagging high dilution risk, market cap under 6 million, and the float read is microscopic. So this can move like somebody turned gravity off both directions. The earlier flush flag got tagged, so fresh scoreboard for me is simple. $5 above, $4.50 below. If buyers reclaim 5 with volume, maybe the tape stabilizes. If it loses $4.50,
Fade risk picks back up fast. No hero ball on this one. Speed, spreads, halt risk, all of it.
I've been digging into the latest jobless claims print, and the big takeaway is pretty straightforward. 209,000 initial claims is a cooling signal, but it is not a layoff wave signal. That distinction really matters for markets, because labor data right now is being used as a proxy for what the Fed can or cannot do next. If claims were breaking out sharply, that would raise recession concern. But at 209,000, we're still talking about a number that is low historically, and still inside the range we've been living with for much of the past year. So the story is not, companies are suddenly firing aggressively. The story is more subtle. Hiring has cooled. Employers are cautious, but existing workers still have unusually strong job security. That creates a much more complicated Fed setup than a simple weak labor market narrative. Let's start with the headline number. Initial jobless claims rose to 209,000. And yes, that was a little above expectations. But this is where context matters. A move above consensus does not automatically mean labor stress. Over the past year, the claims range has broadly lived around the 200,000 to 230,000 zone. And this print is still comfortably in that band. In a genuinely deteriorating labor market, you would expect claims to move persistently higher, not just tick up from very low levels. Historically, claims near 200,000 are still consistent with a labor market where layoffs are limited. So I would not frame this as an alarm bell. I'd frame it as another piece of evidence that the labor market is cooling from a very tight starting point, but not cracking in a disorderly way.
Thanks, Company Desk. Breaking lead here from the macro desk. Anthropic has signed a $9.1 billion cloud deal with Riot Platforms, and Riot is being marked roughly 21 to 24% higher in aftermarket trading. That's the headline. What we know? This is a big AI infrastructure cloud agreement, and it puts a Bitcoin miner right in the middle of the AI compute arms race. What we don't know yet, the full economics, the timing of revenue recognition, capacity build-out costs, and how much of this is margin accretive versus just very expensive infrastructure work. Market read, this is exactly the pivot traders have been sniffing around. Miners trying to become power and compute landlords. Bitcoin mining was the old business card. AI infrastructure is the new suit jacket. Looks better, costs more. Next one on the AI stack. NVIDIA is teaming up with Apollo, BlackRock, Blackstone, Goldman, and Brookfield to raise $500 billion for AI infrastructure. That is not a typo, $500 billion. Why it matters? This tells you AI is moving from a chip story into a financing story. Power, land, data centers, cooling, cloud contracts, the whole plumbing bill is coming due. NVDA remains the flag bearer, and QQQ is still firm here, up about 1.1%, around 731.5, so the tape is not rejecting the theme. But the macro desk's dry little warning label is this: when the funding headlines get this large, investors start asking whether the customer demand is already there, or whether the money is arriving first and the revenues are being asked to catch up later. And the energy headline stays on the board. Iran is maintaining the closure of the Strait of Hormuz, keeping crude elevated and pushing energy stocks higher, while airlines take the other side of that trade. The desk is seeing oil around 124.10 right now, actually down about 2.5% on the session, but let's be real. 124 oil is still 124 oil. That matters for margins, freight, airlines, chemicals, and inflation expectations. VIX is only around 19.6, so equities are not in full panic mode, but this is the kind of cross-asset setup where one headline can move crude, rates, and cyclicals before your coffee cools. Coming up, Market Mover Scan gets the single-name chaos back on screen. All right, macro desk here. Quick wide-angle check, because the bond market is basically telling the stock market it's allowed to breathe. The data point driving the mood is payrolls. U.S. non-farm payrolls fell by 23,000 in July. versus expectations for plus 80,000. That is not a tiny miss. That's the labor market walking into the room and immediately lowering its voice. And look how the tape is processing it. SPY is up at 777.90. QQQ's stronger, up 1.08% at 731.50. And IWM's up 0.59% at 304.49. So equities are not reading this as panic right now. They're reading it as rates relief. TLT is up 0.74% to 82.72. IEF's up 0.45% to 93.38. That's the key chain. Softer jobs data, bond prices bid, yields pressure lower. Duration assets catch a tailwind, and mega cap tech gets the first invite to the party. QQQ is the mood ring here, and right now it's glowing risk on. Now the interesting part is the inflation side, because the market's getting help from oil at the same time. Oil is down 2.51% at 124.10. And remember, the macro desk flagged that 124 area earlier. We got the downside tag, and now it's hovering right back around the scene of the crime. If crude stays heavy, that takes a little pressure off the inflation story. Not solves it. Inflation's that guest who says they're leaving and then stands by the door for 40 minutes, but it eases the immediate panic premium. Gold is down 0.95% at 401.08. So the safe haven bid is not screaming either. Dollars a touch softer, down 0.05% at 28.185. Yen proxy is firmer by 0.15% at 57.605. Even crypto beta is catching some of the liquidity vibe. BITO up 0.58%, Coin up 1.3%, MSTR up 2.33%. That corner is always more volatile and less regulated, but it does tell you risk appetite hasn't left the building. The one little eyebrow raise. VIX is still 19.52, up a hair, so it's not champagne at the macro desk yet. It's more like sparkling water with a cautious label. All right, macro desk time. Payrolls just threw a wet towel on the hot economy story, and the tape is weirdly enjoying it. The headline is pretty clean. U.S. non-farm payrolls fell by 23,000 in July versus consensus looking for plus 80,000. That's not a tiny miss. That's the labor market showing up late with coffee on its shirt. But look at the reaction. SPY's up around 778, plus 0.72%. QQQ's leading at 731.51, up 1.08%. And IWM's green too, up 0.67%. So the first read is not panic. It's rates relief. Bonds are bid. TLT's up 0.74% to 82.72. IEF's up 0.45% to 93.38. Even if you only trade stocks, that bond bid matters because it's the discount rate valve opening a little bit for growth names.
Thanks, Macro Desk. All right, Stock Whisperer checking in on the simulated paper book. The tape is still risk on. QQQ's leading, SPY's firm, but breadth is mixed and VIX is not exactly asleep. So I'm not reaching for a new trade here. This is a portfolio management pass. 6 positions open, and the job is simple. Make sure the risk is actually defined. Here's the book. F is barely green. QCOM is merely green. NVDA and Riot are doing the heavy lifting. PLTR has recovered after that earlier warning flush, and the USO short is still small green. That's fine. Not every position has to be a hero. But when the market is firm and the VIX is still hanging around 19.5, I don't want loose ends. F and QCOM are the two I want to clean up right now. No new shares, no fresh exposure. Starting with Ford, we've got 600 shares long. Average is 1385, last print around 1388, so this is basically flat to slightly green, about $18 open P&L. The thesis is not some massive momentum chase, it's just holding green in a constructive tape, and I'm willing to let it work only if it keeps defending the morning support zone. So the level is 1355 underneath. If it loses that, the idea is wrong enough for this paper book. Upside bracket stays 1510. That's where I'd want the position to get paid if it actually expands.
So I'm sending the protection now. Again, this is the show's simulated paper account, not something to copy, and this is not an entry. It's a risk bracket on a position that already exists. 600 shares, stop at 13.55, take profit at 15.10. I'd rather define the trade and be wrong cleanly than let a small green position turn into a sloppy one. Next one is QCOM. This one's participating, but it's not leading. We've got 50 shares long, average just over 163, last print around 163.44, so it's green by about 21 bucks. In a QQQ LED tape, I'm okay giving a semiconductor name room, if it's behaving, but I'm not going to pretend this is NVDA-style momentum. The stop stays 158.80. That's the line where the setup starts looking damaged. The upside bracket goes 169.50, which is more realistic into resistance than just hoping the whole semi-tape rips forever. Alright, QCOM bracket going in now. Same idea. Not adding, not averaging, not forcing anything. Just defining the exit map. 50 shares, protective stop, 158.80, take profit, 169.50. If it grinds, great, the bracket handles it. If the tape rolls over, I don't want to be debating risk after the fact. That's the Stock Whisperer update. Ford protected, QCOM protected, and I'm not putting on a new trade while the book already has 6 names working. NVDA, Riot, PLTR, and USO can keep doing what they're doing with their levels on the sheet. The main thing is discipline. In a strong tape, it's easy to add risk. In this book, I'd rather tighten the structure first. Coming up, the market mover scan is going back to the names actually lighting up the board.
Thanks, Stock Whisperer. All right, Markets Desk is going straight to the movers board. Tape is green, but not clean. QQQ up about 1.1, SPY up 0.7, Brent mixed, VIX still hanging near 19.6. So single name momentum has room, but I don't want to chase trash just because the index is green. Top of the board, XHG still ridiculous, up 327%, 44 million shares, relative volume over 3,000. DFSC doubled, 52 million shares. FGI still up almost 89% after that earnings runner. Then LIMN, 16-cent biotech, 306 million shares, massive relative volume. Curry, GXAI, ARX rounding out the hot side. So this is not a static board read. We're going ticker by ticker, 1-minute charts, volume, levels, and I'm calling out what looks like real bid versus what looks like Trap City.
Thanks, Markets Desk. Quick Stock Whisperer check on the paper book. This is the show's simulated portfolio, and the fresh ad is SMCI, 250 shares long, average 40.1872. Basically flat right now, around 40.20, up about $3 on the position. The setup is pretty simple. AI infrastructure earnings momentum is still getting bid. CW is already extended and expensive on the tape, so SMCI is the cleaner, lower-priced follow-through vehicle for this paper account. I'm not trying to be a hero here. I want confirmation above 41.25. That's the morning high area I need to see buyers actually take. Otherwise, this is just a starter with defined risk. And here's the bracket, because that's the whole point at the Stock Whisperer. Thesis, level, risk. The stop is sitting at 38.35, so if this AI follow-through fails and SMCI loses the structure, the simulated book gets pulled out. Upside take profit is parked at 44.80. Not a prediction, just the defined exit if momentum expands. Bigger picture, the rest of the book is still green. QCOM and the USO short are doing the most dollar work. Riot and PLTR are modestly positive. Ford is small green. No victory lap, just controlled exposure, while QQQ is firm but bread that's still mixed.
Thanks, Stock Whisperer. Let's snap right into CLBT, because this is downside momentum in a green tape. QQQ's up more than 1%, SPY's green, and this thing is down about 32%. That matters. It opened around 10.92, popped just under 11, and then oof, lower high, lower low, flush. This is not a clean small cap squeeze read, this is a damage control chart. Okay, look at the 1-minute structure. The real break came from that 1030 zone down into 962. And the volume confirmed it. Not light selling, real pressure. Now the bounce has carried it back toward 1025. But the problem is conviction. The rebound volume is only moderate versus the dump. No VWAP tag in this feed, so here at the markets desk, I'm using the candle shelves. 970 is the support zone. 1035 is the reclaim zone. Above 1035 and hold, the tape starts looking less broken. Below 970, especially if 962 cracks, that base attempt can turn into another air pocket fast. Catalyst check now. CLBT is Celebrite, digital investigation software, NASDAQ listed around a 2.6 billion market cap, float roughly 129 million shares. So this is not a tiny sub-dollar halt machine, but a 30% intraday drop is still violent. The press release trail shows the company had a July release setting second quarter results for August 13th, plus product headlines around SkySafe and Genesis. So the tape is treating this like event risk selling, not some random low-volume drift. Price is telling you sellers showed up first. Back to the candles. Scorecard is simple. CLBT is basing, but it has not repaired the breakdown yet. The line I care about is 10.35 on the upside, because that's where failed bounces can turn into real reclaims. Underneath, 9.70 is the floor they need to defend, and 9.62 is the day low trapdoor. I'm not chasing a red to green fantasy here. I'm watching whether buyers can actually absorb supply. Coming up, we'll jump back to the movers board and see what's still holding momentum versus what's already rolled over. All right, markets desk back on the movers board. This is where the tape gets loud. SPY is up about 3/4, QQQ is up 1.2, but breadth is still mixed, so I'm not just chasing green candles here. I want relative volume. I want clean follow-through. Top of the board is still XHG, now up about 339%. Just absurd tape. 45.9 million shares and over 3,200 times normal volume. Right under it, FGI is still alive, up 118% on 40 million shares. DFSC is hanging around too, but that one already started to give back the clean part of the move. Then you've got Curie, GXAI, ARX, LIMN, and on the red side, LESL and FGL are getting smoked. So the game here is simple. What's still expanding, and what's just a bag of late buyers getting passed around. Let's pull up XHG first, because yeah, this is still the headline freak show chart. $4.02 last print, up 339%, and the reported float here is tiny, basically microscopic at 415 shares, so please understand what kind of vehicle this is. Spreads can get nasty, candles can air pocket, and dilution risk is flagged high. Now tactically, the earlier $4 reclaim is the whole conversation. We're not celebrating it just because it's over 4 by a couple pennies. That's not enough. I want to see if buyers can actually lift the offer above 420. That's the fresh proof line for me on this pass. Above 420, okay, maybe the second leg is trying. If it just keeps wicking through 4 and snapping back, that's not clean momentum. That's trap behavior. Oof. And with a move this extended, every failed push matters. Next, we'll rotate to FGI, because that one's still printing real volume without being this microscopic.
I've been digging into the July inflation setup, and the clean read is this. The data bought the Fed time. It did not declare victory on inflation, but it did make the argument for an immediate September hike harder to defend. Headline CPI was soft on the month. Core CPI cooled. PPI looked tame. And jobless claims suggest the labor market is losing some heat without falling apart. That is basically the soft landing cocktail markets want to see. But there's a big caveat, and it's gasoline. Energy pressure came back late July into early August, and if that shows up in the next inflation report, the hike debate can come back fast. Let's start with CPI, because that is the number the market reacts to first, even though it is not technically the Fed's preferred inflation gauge. The July read, as framed here, showed consumer prices up just 0.1% on the month, with the year-over-year rate around 3.4%, a touch lower than June. The important part is not just the headline. Headline inflation can be pulled around by energy. The better signal is the underlying trend. And if core inflation is only rising 0.2% month over month, that is a pace the Fed can live with for now, especially compared with the inflation shock of the last 2 years. Core CPI is really the center of this debate. The research has core inflation slowing to 2.5% year over year, and I'd want to verify that exact figure against the official release, because core CPI has often been running above headline in this cycle. But directionally, the point matters. If shelter, core goods, and services are cooling together, the Fed has less reason to rush. 1 month is not a trend, and Fed officials will say that out loud. But the July mix argues that restrictive policy is finally biting. That supports patience. Keep rates high, let the lagged effects keep working, and avoid adding another hike unless the data forces it. Now shift to PPI, because producer prices give us a read on pipeline inflation. July PPI was flat in this research summary, and annual PPI slowed to 4.7% from 5.5%. That is constructive if you are looking for lower inflation pressure flowing through the economy. Lower producer inflation can mean companies face less pressure to raise final prices, or at least less pressure than they did during the supply chain squeeze. But we should be careful here. PPI does not translate one-for-one into CPI. Margins, inventory, contracts, and sector mix all matter. Still, flat monthly PPI makes it harder to argue that inflation is suddenly re-accelerating beneath the surface. The Fed reaction function is the key. This is not a central bank that wants to sound relaxed. The July meeting tone was still hawkish, and the research notes that 3 officials dissented in favor of a hike, while the majority preferred patience. That tells you there is still a live debate inside the Fed. The majority does not need inflation to be perfect to hold. It needs enough evidence that policy is restrictive and the trend is improving. The hawks, on the other hand, will focus on the risk of stopping too early. So September is not about one number. It is about whether the balance of evidence supports waiting. This is where policy lags matter. Rate hikes do not hit the economy instantly. They filter through mortgages, credit cards, corporate borrowing, bank lending standards, hiring plans, and capital spending. By the time every effect is visible in the data, the economy may already be slowing more than the Fed intended. That is the argument for a September hold. Rates are already restrictive relative to recent history. Inflation is no longer accelerating like it was, and the labor market is cooling. A hold would not be a pivot or an easing move. It would simply mean the Fed is choosing to watch the data before tightening further.
Thanks, Company Desk. Breaking headline first. Airbus supplier engine delays are now hitting the delivery schedule. ProTerminal's newsroom is tracking a warning from a key Airbus supplier that engine production delays are stretching further, and that puts pressure right back on Airbus delivery timelines. What we know, this is an engine supply bottleneck. It affects the ability to hand planes over on schedule, and it raises order fulfillment risk across the aerospace chain. What we do not know yet, the size of the delivery slip, which customer slots get pushed, whether Airbus changes guidance, or how much can be absorbed with existing inventory. So the market read, clean and boring, which is usually correct, is aerospace supply chain risk just moved back to the front row. Broader tape is green, SPY around 778.6, but lower oil at 123.51 does not fix a missing engine. Cheaper fuel for a plane you can't deliver is a very macro kind of joke. Next headline. Blackstone and Legal & General are launching a private credit partnership targeting up to $20 billion in assets. What happened? They're tying up to build out alternative income exposure through private debt. Why it matters? This is the credit market continuing to migrate away from the old bank lending lane and into private balance sheets. That can shape fund flows, credit spreads, and how much yield investors are willing to lock up for. Here at the macro desk, the tell is bonds are bid too. TLT 82.84, up about 0.9. IEF 93.44, up about 0.5%. So this is not nobody wants credit. It's everybody wants income, but the wrapper keeps changing. Just remember, private credit usually puts the exit door behind a velvet rope. Third headline, Citi raises Nvidia price target to 190 on AI demand growth. This is the analyst's view. Stronger AI accelerator demand, data center spend, and Nvidia still sitting in the middle of that semiconductor toll road. Why it matters for the market is simple. NVDA is not just another ticker. It's a risk appetite dial for QQQ, and QQQ is around 732.3, up 1.19%. So the growth side already has the ball this morning. The flip side is the bar keeps moving higher. Every target hike makes the next earnings proof point more important. So no, that 190 is not the macro desk telling anybody what to do. It's a sentiment input. Coming up, the market mover scan should tell us if this AI bid is spreading or if it's just the usual mega cap gravity doing the lifting.
Thanks, Macro Desk. Quick pro terminal pit stop, because this is literally the board we're trading off here at the markets desk. Movers, gainers, losers, relative volume, price, all in one place. Not a buy list, not a magic button. It's the radar. XHG up top, FGI right behind it, DFSC still on the board, boom, that's how fast the tape tells you where attention is going. Then I don't sit there staring at the row. I hit the chart, 1 minute terminal, right away. This is the whole point. If a name is screaming on the movers board, I want candles, volume bars, wicks, the failed pushes, the real bids, the places where it stuffs. Oof, look at that kind of tape. You can go from stand to execution level research in a couple clicks, without guessing from a headline. And on the small cap runners, the next stop is risk, always. Dilution center, shelves, ATMs, offerings, registration statements, that stuff matters when a chart is flying, because supply can hit fast. Pro Terminal pulls that into one workflow so you're not just chasing green candles. Data can be delayed, incomplete, or just messy sometimes. So treat it like research context. Educational stream only. But yeah, this is where I check whether the move has paper over its head. Last piece, filings and insider tabs. I'll pull the profile, hit filings first, then insider activity. That's the cleanup pass. What did the company actually file? Any offering language? Any recent insider buying or selling? Again, it's not telling you what to do. It's giving you the facts faster, so you're not trading blind. Everything you're seeing on this show, movers, charts, dilution, filings, insider trades, that's Pro Terminal. If you want the same dashboard, sign up at proterminal.io. Coming up, we're right back to the market movers scan.
All right, markets desk back on the movers board. Let's see what's actually still got juice here. QQQ's still green, SPY's green, but breadth is mixed. So I care way more about names holding their own volume than just the headline percent move. XHG still sitting at the top of the board. FGI still huge. DFSC still hanging around that post-spike zone. GXAI is the fresh AI small cap interest. Curie still bid after the earnings push. And then look at the bottom. LESL down 40%, CLBT still red, but we did get that 10.35 reclaim hit a minute ago. So keep score. Some of the earlier levels are getting tagged. Now we go chart by chart. No guessing. 1 minute tape only. First up, XHG. And oof, this is still the wild one. We flagged that 420 proof line earlier and it did hit. So now the question is whether this thing can actually accept above the mid-4s, or whether that was just the squeeze candle and then the rug. It's around 445 on the board, up almost 400%, with more than 50 million shares traded. That is not normal tape. But this is also the exact kind of micro-float, high-dilution risk name where the spread can go stupid fast. I'm not chasing the headline move here. I'm watching whether 450 gets clean acceptance on volume. If it stuffs there and starts losing the prior push, that's where these can go from hero candle to air pocket in about 30 seconds. Watch the bodies, not just the wick. FGI next. This is the cleaner continuation check after that monster move, and the whole fight is basically happening around $10. We're at $9.85, still up 108%. So yeah, that's a huge headline number. But the part I care about now is, Does 10 turn into a ceiling, or do buyers keep accepting it up here? 42.8 million shares traded, 131 times relative volume, and the float is only about 520,000, so every push can get exaggerated. If this keeps rejecting right under 10, that's usually where late momentum starts getting messy. If it can reclaim and hold above 10, with volume still coming in, then it's telling you that Chase hasn't fully backed off yet. I'm not chasing the print. I just want to see whether the tape is tightening or getting sloppy around that level. Now, DFSC. Different feel here. Still a big gainer, up about 95%. Price sitting around 2.42. Almost 60 million shares traded. But this is the fade versus rebuild read. We had that prior defense zone get undercut, so I'm watching whether sellers are still pressing below roughly 2.40, or whether the selling is actually drying up and it starts basing again. That's the difference between a failed runner and a name that's just cooling off after a ridiculous open. Relative volume still over 100 times normal, float around 1.35 million, so it can absolutely whip both ways. If 2.40 keeps acting like resistance from underneath, that's a problem for momentum. If it reclaims and starts holding above it, then the chart at least gets back into rebuild mode. GXAI now. This is the AI small cap momentum name. And yeah, the volume is real on the tape. 57 million shares, about 363 times normal volume. Price sitting right around 1.29. So the whole read for me is that 1.30 area. If it can actually live above 1.30 instead of just poking through and stuffing, that's where momentum traders start paying attention again. But here's the catch. High dilution risk on this one, roughly a 15 million market cap, and it's already done a big move. So I'm not treating this like some clean mega cap breakout. This is small cap AI flow. It can move fast both ways. Watch the candles around 1.30. Watch whether volume expands on the push, and watch whether it immediately fades back under that line. CURI next, totally different profile. Curiosity stream, streaming and media name, up about 45%, trading just over $4. And this one's got a cleaner market cap than the ultra tiny runners we were just looking at, around 240 million. Volume solid too, 12 million shares, 25 times relative volume. So the question here is simple. Is this actually trending, or is it just a gapping grind parked around 4? If the 1-minute chart keeps respecting that $4 area, that's constructive. If it starts chopping under 4 and every bounce gets sold, then it's more of a post-news digestion tape than a momentum chase. Nice move, cleaner than the sub 10 million names, but still, I want to see whether buyers keep defending the line. RX next, and this one's got a totally different personality than the micro-cap rockets. This is a financial services name, insurance broker space, about a 2.2 billion market cap, up 43%, and it's trading like a deal-driven tape around 1950. You've got 34 million shares through it, relative volume almost 29 times, so the participation is there, but this isn't the same kind of chase candle as XHG or FGI. For me, 1950 is the magnet. Above it, the tape looks like it's stabilizing. Below it, you start watching for that ARB-style drift where buyers stop pressing. Now flip the board red for a second. LESL is ugly. Leslie's under $1, 79 cents, down about 40%. And that matters because the market's green today. SPY and QQQ are higher, so this is not just broad tape weakness. This is single name pressure. Volume's over 2 million, relative volume 11 times. And once a formerly higher quality consumer name is living under the $1 line, the chart gets really unforgiving. I'm not chasing that kind of breakdown. I just want to see if $1 becomes resistance on any bounce. And quick CLBT follow-up, this is the red board name that actually gave us the cleanest intraday level. We flagged that 1035 reclaim earlier, and yeah, it hit. Price is sitting right around 1036 now, still down 32%. So don't confuse a reclaim with the all clear, but that level mattered. Above 1035, shorts have to respect the bounce attempt. Below it, it can go right back to heavy. Alright, that's the movers board pass. We've got our key levels logged, and we'll flip to the next setup from here. Alright, PSQH now. This is the small cap momentum chart I want on the screen. Oof, look at that move. This thing was dead money under $4, grinding lower from around 397, tagged down near 3.57, and then bang, volume hits. Price clears that old $3.80 to $4 range, and now we're holding up in the 530s. That's a full character change on the 1 minute. Not clean, not calm, but real volume showed up. Here's the market's desk level map. Day high is basically 550. That's the lid. Current action is trying to stay elevated around 530 to 550, so if PSQH can actually accept above 550, that's the fresh momentum proof line. But if it loses $5, that gets sketchy fast, because the entire breakout is stretched away from the prior base. The real launch zone was closer to 440, and the old range was 380 to 400. So yeah, this is up huge, market's green, IWM's green, risk appetite is there, but the chart is already parabolic. That means the same candles that make it exciting can rug pull just as fast. Quick catalyst check. I'm not seeing a fresh same-hour press release in this feed driving the spike. The recent company items are older. A 1-for-15 reverse split announced July 9, a PSQ Payments customer headline on July 1, and then the May financials. So don't confuse the candle with a clean, fresh news catalyst. The tape is moving first here. That matters, because when a small cap rips without a clear new headline, the levels and volume are the story until proven otherwise. Last thing, risk check. Dilution Center has PSQH marked low current dilution risk. No active shelf, no active equity line, no pending S1 in that snapshot. Good to know. But it's still a tiny market cap name with a reverse split headline in the rear view and a parabolic candle on the screen. So this is absolutely not a sleepy chart. No halt flag in the data I've got, but small cap momentum can trade like halt risk anyway. For me, the scoreboard is simple. Above 550 proves buyers still have control. Below 500, the breakout gets vulnerable. Coming up, we'll jump back into the movers board and see what else is rotating. All right, let's reset the movers board. Markets Desk wants the fresh tape right now. SPY and QQQ are green. IWM's green too, but VIX is also green, and breadth is mixed. So this is not a clean everything rips market. It's selective. Top row is still wild. XHG, FGI, DFSC, we've already got those on the scoreboard, so I'm not wasting your time rereading the same stats. The new thing jumping off the board for me is LIMN, 15-cent biotech up about 42%, and oof, 330 million shares already with over 1,100 times relative volume. That's the crowd. Then on the red side, FGL is getting hit, LESL is still ugly under $1, and OBX is down 34%, but with very light listed volume. So we're going chart first on LIMN because that's where the tape is screaming right now. Okay, LIMN on the 1 minute. This is exactly the kind of name where the chart matters more than the headline label. It's a clinical stage biotech, market cap under 10 million on the board, dilution risk tagged high, and the stock is only around 15 cents. Not sub-dime, but still penny stock rules. Spreads can get nasty, halts can happen, and dilution risk is not some tiny footnote. The line I'm marking is 15 cents. Above 15, the crowd can argue momentum is still alive. If it keeps slipping back under that zone, this starts looking more like volume churn than clean continuation. And with 330 million shares traded, that's the key. Huge volume is great when it lifts offers. It's dangerous when it turns into trapped volume. So for LIMN, Markets Desk scorecard is simple. 15-cent acceptance, or this thing gets messy fast. Now FGL, this is the first loser I want on the 1 minute, because it's sitting right around that $0.50 zone, and it's not getting the same kind of chase the green names are getting. Price is about 48 cents, down almost 39%, so yeah, ugly red board tape. But here's the thing. The relative volume is showing 0.44, and I don't want to overread that like nobody's touching it. It's still done over 6 million shares. It's just trading against a pretty heavy average volume base. For me, the clean line is simple. Can it reclaim 50 cents and actually hold it? Or does every pop into that area keep getting sold? Under 50, it's still in prove it mode. OBX is a totally different kind of red name. Down 34% biotech, but look at the volume, only about 24,000 shares listed on the board. So this isn't the same read as a liquid washout, where you've got huge volume confirming every candle. This is thin, and thin biotech gaps can get nasty both ways. Wide spreads, air pockets, one print changes the look of the chart. So I'm not trying to make a giant statement off 1 minute candles here. The move is real on percent change, but the liquidity is the story. If you're watching it, the first question is not, is it cheap? It's can you even trust the tape and get clean fills around these levels? Curry. Now, this is the one where we had that $4 downside line open, and so far, honestly, it's trying to deny the breakdown. Last print's around 402, up about 44% on the day. Volumes 13 million plus, nearly 27 times normal, so there's real tape here. But the key is simple. Is $4 turning into a floor, or is it just a pause before sellers lean again? Right now, I'd call it digestion, not a clean failure. If it starts living under 4, then that downside callout wakes back up. But while it's holding just above it, you can't call that broken yet. RX next, and this one's a different animal than the low float screamers. Bigger market cap, insurance broker name, volume still heavy at almost 35 million, but the tape is way steadier. That 1950 line we've been tracking is basically the whole story. Price is sitting just above it, around 1957. So for now, it's stabilization, not momentum chasing. If you're comparing it to GXAI or FGI, totally different feel. RX is more of a deal-driven hold-the-line trade. Above 1950, the board's respecting it. Lose that, and then you watch how quickly the bid gets tested. All right, GXAI now. This is the AI/gaming name, and this is the cleanest little scoreboard check because the line is simple, 130. Last print's around 127, so it is not proving that level yet. And with the board this green, QQQ up over 1%, you want to see bids rebuild, not just a random wick back into resistance. Volume's real though, 59 million shares, roughly 375 times normal volume, so the crowd is definitely here. For me, 130 is still the proof line. Above it and holding, okay, now the tape changes character. Under it, it's still just a pop that's getting supplied into.
Thanks. Markets Desk. Breaking news first. Qualcomm is jumping on ProTerminal's report that it's working with OpenAI around AI features for Qualcomm-powered smartphones. What we know? The market is treating this like Qualcomm getting closer to the actual consumer AI device layer, not just selling chips into the background. What we don't know yet, deal terms, timing, economics, exclusivity, which handset makers are involved, all the boring details that, annoyingly, decide whether the pop has real legs or just a nice headline hat. The market is pretty clear though. QQQ is already firm, up about 1.34% near 733.4. And this lands right in the mobile AI bucket. Here at the macro desk, that matters because AI is trying to move from data centers into pockets. And if it's in your pocket, Wall Street can model it faster than a teenager drains a battery. Next headline. Netflix is lower after a disappointing profit forecast, and co-founder Reed Hastings is set to exit the board. That's a 1-2 punch. Margins first, governance second. The stock-specific read is that investors are not just paying for subscribers anymore. They're grading content spend, ad tier execution, and whether streaming can keep expanding profit without turning every household into a monthly billing experiment. And notice the tape context. Broader tech is green, QQQ still up over 1%. So Netflix weakness is not just market red, stock red. This is idiosyncratic pressure, which usually gets more attention from fast money. And the bigger theme tying those first two together, big tech is being pushed to justify AI spending. ProTerminal's newsroom is tracking investor pressure on Apple, Microsoft, Google, and Meta to show actual returns from AI investment, not just bigger CapEx slides and shinier demos. The cross-asset backdrop is giving growth some air cover. TLT is up about 1% near 82.94. The dollar's softer around 28.16. And QQQ is bid. But that doesn't mean every AI dollar gets forgiven. The market is starting to separate AI with distribution, like phones and software workflows, from AI with only a giant electric bill. Coming up, we'll flip back into the movers board and see which single names are actually confirming this tape.
Thanks, Macro Desk. Let's stay with AI, but do it the company desk way. What actually changed for the business? Pull up NVIDIA first. This is the lead dog, obviously, but look at the setup against the tape. QQQ is up about 1.3%. Nvidia's green too, but only about 0.75% at 225.80. So it's not some runaway squeeze right now. It's participating, not dominating. For me, the clean little line is 226. If buyers can accept above that, okay. The AI leader is confirming the risk-on tape. If it keeps stalling there, then maybe the market likes tech broadly more than it loves the Nvidia-specific story today. Now here's the story piece, because Nvidia is never just a chart anymore. The fresh headline in the stack is Jensen Huang warning about a pretty ugly outcome if China's AI ecosystem optimizes around Huawei hardware instead of American chips. And that matters because it's not just a politics headline. It goes right at the durability of demand, export access, and whether Nvidia keeps the global developer mindshare. Then underneath that, you've got these Blackwell capacity references in the press releases. Cumulus AI talking Nvidia Blackwell B300 capacity. Zayo talking AI factory network capacity. That's the bullish business arc. Compute is still scarce, and the ecosystem is still building around Nvidia. But here at the company desk, the skeptical question is simple. Does that become durable revenue and margin? Or is the market just rewarding another round of CapEx headlines? Quick filings check too. There's a Form 4 accepted yesterday, plus another one last week. I'm not making that the story, but it's on the tape. Alright, rotate the theme. Broadcom next. AVGO is the confirmation chart for me, because the business read-through is different. Nvidia is the GPU platform. Broadcom is custom silicon, networking, hyperscaler-specific build-out. Basically, are the big customers still spending on the full AI stack, not just chasing one supplier? I'm not going to invent a price level here without the candle packet. But visually, this is the name I want next to Nvidia. If AVGO is confirming, the market is saying AI CapEx is still a broad semiconductor revenue pool. If it's dragging while Nvidia holds up, that's a more selective tape. And that's usually where the market starts asking tougher questions about who actually gets paid. Now, Marvel. MRVL is the more sensitive read on the plumbing side of AI. Data center connectivity, custom silicon exposure, optical and networking type demand. The reason I care about this one in the theme is because AI spending has to move beyond the headline GPU order. If the only stock that works is Nvidia, that's concentration. If Marvel starts acting better with the group, then the market is saying, okay, the second-order AI infrastructure names are getting credit too. And that fits the bigger debate from the news stack. Investors want proof that this giant AI spend actually turns into returns. MRVL is one of those proof-of-spend names. AMD is the challenger read. Different story than Nvidia. Nvidia is installed base, software moat, ecosystem. AMD has to keep proving the accelerator roadmap can win real enterprise and hyperscaler dollars. Not just sympathy bids when the AI basket is hot. The AI headline we have in the stack also flags NVDA and AMD around key moving average support. So this is sentiment sensitive. On a day where QQQ is up more than 1%, AMD lagging would matter. AMD confirming would tell you the market is buying the competitive AI chip theme, not just the incumbent. That's the difference between a sector move and a one-name leadership tape. So, tie it together. The AI tape today is less about hype, more about proof. Nvidia has the clearest demand story, but it's also carrying China access risk and the biggest expectations in the entire market. Broadcom and Marvell tell us whether the infrastructure spend is broadening. AMD tells us whether the market still wants the challenger. And with VIX green, even while QQQ is ripping, I'd rather see confirmation across the stack than one flashy headline. Coming up, we'll kick it back to the movers board and see where the real-time volume is hitting now.
Thanks, company desk. All right, markets desk is grabbing the movers board right now. Yeah, this is a wild board for a market that's already green. SPY up about 0.8, QQQ up 1.3, IWM green too, but breadth is still mixed, so don't just assume everything is easy. Top row is XHG, up 375%. Oof. 55 million shares versus basically no normal volume. That's the definition of a scanner siren. Right under it, FGI still up over 100%, sitting just under $10. DFSC up 80 plus, 63 million shares. GXAI holding the 130 zone from earlier. Then Curie and ARX are still on the board, but those are more level check names now, not fresh shock value. We're going top down, chart by chart. First one is XHG on the 1 minute because this is still the top headline on the board. Price is $435, up 375%, and the relative volume is absurd. 3,863 times normal. That's not normal interest, that's event-style chaos. Market cap on the feed is only about 4.7 million, shares outstanding under a million, and the float field is basically microscopic, so the tape can move violently both ways. Also, dilution risk is marked high, so I'm not treating this like some clean institutional breakout. I'm treating it like a fast small cap auction. For the chart, the big thing here, after a move like this, I want to see if buyers keep defending the low fours. $4 is the danger line for me. Above it, it can still churn and trap shorts. Below 4, that bid is slipping and the move starts looking tired real fast. No chasing glory candles here, just levels and volume. FGI next. Pull this one up on the 1 minute. This is the cleaner psychological level trade on the board right now. 982, up 107%. And everybody can see that big round $10 spot sitting right above it. That's the magnet, but also the rejection zone. If this thing keeps tapping 10 and can't actually accept above it, that's where the late buyers can get chopped up. Volume's legit. 47.9 million shares, about 147 times normal. And the float is tiny, just over 500,000 shares. So yeah, it can move fast both ways. Medium dilution risk in the background, so I'm not treating this like a clean blue chip breakout. For me, watch 10. Above 10 with real bid underneath is different. Under 10 and fading back into the high 9s, that's digestion, not clean continuation.
Thanks, Markets Desk. Quick check-in here at the Stock Whisperer. This is the show's simulated paper trading portfolio, and the newest position on the board is SMCI. Long 180 shares, average price 41.7687, last showing about 41.75, so basically flat right now, down roughly $3 in unrealized P&L. The setup is simple. SMCI is catching that AI server guidance bid, and instead of chasing every tiny AI runner, this gives us a more liquid continuation read on the same demand catalyst. Thesis, then level, then risk. That's the process. I'm not asking anybody to copy it. I'm showing how we structure it on the broadcast account. Now the bracket matters more than the entry. SMCI has a take profit order sitting at 45.80 and a stop at 39.90, so the risk is defined before the trade gets exciting. For a clean confirmation, I'm watching 42.75 above. If it can hold and extend through there, the post-news push is still alive. If it slips under 40.50, that's my failed momentum warning, and I reassess the long exposure. Quick portfolio temperature check. QCOM is the best open widder, up about $126. USO short is up about 100. Riot and PLTR are green but modest. SMCI is the fresh one, so I'm grading it from here, not celebrating it early. Coming up, we'll kick it back into the movers scan.
Thanks, Stock Whisperer. All right, Macro Desk has the wires, and first up is CoreWeave. ProTerminal's newsroom is tracking CWVE, ripping roughly 19 to 21% after Q2 earnings showed exploding AI-driven GPU compute demand. That's the good part. The less cuddly part. Losses widened, so the market's cheering growth while still quietly checking the cash burn in the glove box. Why it matters. This is the AI infrastructure trade, getting real revenue validation, not just vibes. And with QQQ up about 1.2%, today's tape is willing to pay for that story. Next headline, Supermicro is jumping about 13% after strong Q4 fiscal 2026 guidance. And the driver is pretty direct, robust AI server demand. That matters because SMCI sits right in the plumbing of the AI build-out. If CoreWeave is the customer demand side, Supermicro is the rack and server side. Here at the macro desk, that's 2 points on the same line, and 2 points is where the market starts drawing trend lines with a Sharpie. Now NVIDIA. The desk is seeing NVDA supported by partner strength and a newly revealed financing arrangement, around $500 billion, with structure meant to limit NVIDIA's credit risk exposure per deal. That's important, because one of the big questions around AI CapEx is, who's actually funding the boom, and how much risk sits on supplier balance sheets? The stock move noted here was about 1.2% pre-market, not fireworks. But for a name this central to the whole AI machine, the financing details matter almost as much as the chips. Deal tape now. Goldman Sachs is acquiring Neos Investments in a cash and equity deal worth up to roughly $2.25 to $2.3 billion. The reason this matters is product shelf. Neos gives Goldman more exposure to options-based income EFTs and crypto income strategies. Basically, the Wall Street version of buying the factory that makes the yield wrappers. Crypto-linked names are green on our cross-asset board too, with MSTR up about 3.5%, so the timing is not exactly subtle. And last one for the brief. The U.S. Strategic Petroleum Reserve drew 6.1 million barrels in the week ending August 7th, the sharpest weekly decline in years. That's a supply cushion story, and it matters for crude, energy equities, and inflation sensitivity. Funny twist, oil on our board is actually lower today, down about 2.2%, around 124.50, so the market is not treating this as a straight line squeeze right this second. Coming up, Market Movers Scan. We'll see which of these headlines is actually pulling volume, not just headlines.
Thanks, Macro Desk. Alright, Markets Desk is back on the movers board. And look, the index tape is green but not totally clean. SPY up about 0.7. QQQ ripping 1.25%. IWM green. VIX basically flat. Bread's mixed. So this board matters. These are not calm moves. XHG is still the monster. 403, up 340%. 56 million shares, almost 4,000 times relative volume. FGI right behind it, up 138. DFSC up 76. GXAI and Curie still on the green side. Then LESL is the ugly one, down 42% at 76 cents. So the job here is simple. What's actual momentum and what's just a liquidity trap with candles flying everywhere? Pulling XHG first because oof, this is the headline candle of the board. Current price is 403, up 340%, and the volume is the story. 56.5 million shares versus a tiny normal volume base. Reported float on the board is microscopic, 415 shares, market cap under 5 million, and dilution risk is marked high. So I'm not treating this like a normal liquid large cap chart. I don't have a clean VWAP number in front of me, so keep it brutally simple. After a move this vertical, the low 4 handle is the battleground. If the 1-minute tape keeps rejecting pushes and printing lower highs there, that's fade behavior. If buyers keep absorbing dips and volume stays aggressive, that's still squeeze tape. But this is exactly the kind of name where spreads, halts, and dilution headlines can smack you fast. Watch the tape, not the story. Now, FGI. This one's cleaner than XHG in the sense that it's not a 400% asteroid candle, but it's still a monster move. We're at 1125-ish, up about 138%. And the volume is real. 50 million shares, about 155 times normal. Tiny float too, just over 500,000. So yeah, it can move like a video game. What I'm watching here is the prior round number battle. $10 was the big psychological zone after this exploded higher. And as long as buyers are defending above that 10 area, the tape still has that controlled strength look instead of full unwind. Above 11, it's still acting firm. Under 10, totally different conversation. That's where the clean runner starts turning into people hitting bids. DFSC next. Defense name, aerospace and defense category, and this one is way choppier. Price is around 218, up 76%, but look at the volume. 65 million shares, over 100 times normal. So there's activity, no doubt. The issue is the action around the lower twos. When a stock is doing huge volume, but it's living right around 220, 210, $2. That can either be accumulation or it can just be churn. Buyers and sellers absolutely punching each other in the face. For me, $2 is the line that matters on this one. If buyers keep defending above 2, momentum is still alive. If 2 snaps, that's usually where these small cap defense moves can go from exciting to heavy real fast. GXAI now. And I'm not going to rehash the whole setup because we already had the proof area mapped earlier. The question is just, are buyers still defending it or is this losing control? Price is around 129, up 48%, and the volume is still wild. 61 plus million shares, almost 400 times normal volume. So yeah, there's still attention here. But the tape I care about is whether it keeps holding that 125-ish area on dips. If it keeps reclaiming 130 after flushes, buyers are still in the fight. If it starts accepting below 125, that's where this turns from momentum into bag holder chop pretty fast, especially with high dilution risk on the profile. Now compare that with Curry first. This is a way cleaner mover structurally than the tiny float chaos at the top of the board. Curiosity stream is around 404, up 44%. 14 million shares traded, about 29 times normal volume. Bigger float, bigger market cap. Less of that one candle can wreck the whole chart feeling. And with QQQ still firm, up about 1.25%, this kind of communication services relative strength matters. It's not just a dead market penny squeeze. All right, flip to ARX. Same percentage neighborhood, but totally different beast. ARX is near 1955, up 43%, nearly 39 million shares, and this is a $2.2 billion NYSE financial name. So when ARX is moving like a microcap, but it's not built like one, that tells you institutions or event-driven flow may be involved. Curry and ARX are the cleaner side of the board for me. XHG, DFSC, GXAI are the chaos side. Different tape, different risk. All right, loser check before we hand it off. Lesl is the ugly one on the board, and this is not me trying to bottom fish a sub-dollar name. Leslie's is around 76 cents, down 42%, volume about 3 million, nearly 16 times normal. So yeah, there's real sell pressure here even with SPY and QQQ green. Under $1, the tape gets nasty fast. Spreads widen, liquidity can disappear, and every bounce can just be shorts covering into another lower high. For me, the line is simple. If this can't even reclaim the 80-cent area, it stays in broken chart mode. Now, quick speed round. LIMN is the penny biotech volume monster. 15 cents, up 40%, 343 million shares traded, over 1,100 times normal volume, and dilution risk is marked high. So that's pure caution, not a clean, this is healthy read. FTL is the opposite, 48 cents, down 39%, but relative volume is only 0.45, so that's a weak loser, not really a hot volume panic name. And OBX, biotech again, down 32% at $19 on just 40,000 shares, so I'm treating that as a drop check, not a momentum tape. Good movers scan right there, monsters up top, real danger underneath. Coming up next, let's flip toward the next beat and see what the broader tape is giving us. All right, let's get off the small cap blender for a second and pull up a real mega cap read. Google on the daily. This is clean. Stock's around 347 and change, up about 1.1%, so it's basically hanging with QQQ, but not really leading it. QQQ's up 1.2%, breadth is still mixed, so for a name this big, I care about structure more than the headline green. And the structure here? Big expansion, hard give back, now a base. Look at the daily candles. You had that monster volume move up into the upper 300s. That 374 to 385 zone was the momentum pop. Huge volume behind it. Then, oof, the pullback was not gentle. Sellers took it back into the low 340s. And now, we're just chopping. The range I care about, 340 underneath, 385 overhead. Simple. Below 340, the base starts failing and the chart gets heavier. Above 385, that's where the prior breakout area comes back into play. But right now, it's not there yet. It's sitting mid-340s, just around the 20-day area. All the 50-day is still up around 354 to 356. So the market's desk read is green day, yes. Clean trend? Not yet.
Thanks, Markets Desk. Quick market minute reset here at 11:02 Eastern. If you're just joining us, the headline is simple. Risk on, but not exactly a parade. SPY is at 777.9, up 0.7%. QQQ is doing the heavy lifting at 732.8, up 1.25%. So NASDAQ has the steering wheel again. IWN's green too, but only up about 0.5% at 304.1. And breadth is mixed. That's the little footnote the market tries to hide in size 6 font. VIX is basically unchanged at 19.45. So volatility isn't collapsing. It's just not getting invited to lunch right now. Big picture, growth is bid. Small caps are participating. But this is still a selective tape. Not everybody gets a trophy tape. The cross-asset story actually explains a lot of it. Bonds are catching a bid. TLT up 0.88% at 82.83, IEF up 0.48% at 93.41, so the market's getting a little rates relief. The dollar's softer, down 0.14% at 28.16, while the yen proxy is a touch firmer at 57.64. That combo is usually a friendlier backdrop for duration names, which is fancy macro speak for. Tech likes it when yields stop yelling. Oil is the pressure valve today, down just over 2% at 124.73, and gold is off 0.7% at 402.07. So some inflation and safe haven premium is bleeding out at the same time. Crypto's not fighting it either. BITO up 0.76%, coin up 0.5%, MSTR up 3.22%. On the calendar, keep 12:15, 12:30, and 12:40 Eastern on the radar. Fed hammock, the jobless claims and PPI packet, then Fed barkin. The board shows PPI at 0.0 versus 0.2 expected, core PPI at 0.2 versus 0.3, and claims at 209 versus 202. So the market has a cooler inflation breadcrumb, but a slightly softer labor crumb sitting right next to it. Watch QQQ's 732.5 area as the intraday mood ring, and oil staying below 125 as the inflation pressure tell. Coming up, we've got another market mover scan, then a quick pro terminal plug before we hit the movers again.
Thanks. Macro desk? Alright, markets desk has the movers board up. Let's hit the tape. QQQ's up $1.25, SPY's up 70 bips, but breadth is still mixed. So these board names are not just drifting with the market. This is single name flow. Top of the board, XHG is still ridiculous, up about 356%, 57 million shares, 4,000 times relative volume. FGI is still hanging above that $10 line we flagged earlier. Scoreboard, that one hit. DFSC is back around 228 after that 225 downside tag, so that's a tug of war now. GXAI is sitting right around that 130 proof zone. Then ARX and Curry are the cleaner middle board names I want after the chaos. First chart up, XHG, because when a stock is doing 4,000 times normal volume, you do not read it like a normal tape. Okay, XHG on the 1 minute. This is the monster. 417 on the print, up 350 plus. 57.7 million shares traded. Relative volume over 4,000. Market cap in the data is only about 4.7 million. Shares outstanding just under a million. So every candle here can get nasty fast. I'm not treating this as smooth momentum. I'm treating it like a stress test. If it can push through 435 and actually hold the offer, buyers are still pressing. If it starts accepting below 390, oof, that's where this can flip from squeeze to air pocket really quickly. With a name this thin, the wicks matter more than the headline percent. I want the next few candles to prove the bid, not just flash one green bar and disappear. Now, FGI. And yeah, scoreboard that $10 level from earlier, because that one got tagged clean. That's the kind of thing you want from these low float names. Level clears, volume piles in. Then you see if it can actually build. FGI's at 1130 right now, up about 139%, 55.6 million shares, and the relative volume is still wild, about 170 times normal, on a float barely over 500,000. So this thing can move, but it can also air pocket. The question now is 11. If 11 holds as support, this is still squeeze control. If 11 breaks clean and those red 1 minute candles start coming with size, then that $10 breakout was real, but the $11 push might just be squeeze hangover. DFSC next. Different look here, still moving, but I'm watching the reclaim instead of just the vertical chase. It's 228 up about 84%, 67.5 million shares traded, relative volume 117 times normal. Floats about 1.35 million. So again, small cap rules. Levels matter, liquidity matters, and you do not want to ignore how fast these can unwind. On this 1 minute, the low $2 area is the battleground. I want to see 220 hold on pullbacks and 230 actually get accepted, not just a wick through it. If 230 pops but the volume fades, that's usually a warning. If volume expands through that area and dips keep holding 220 to 225, then the reclaim attempt looks a lot healthier. GXAI now. This one's sitting basically right on the line, 130 on the print, up about 49%, and the volume is real, 62.9 million shares, almost 400 times normal volume. So for me, this is the proof zone check. If buyers are still in control, you want to see 130 act like a floor, not just a price that keeps chopping through. Under that prior weak control area, call it the low 120s if the chart starts leaning down, momentum can disappear fast, especially with a high dilution risk small cap like this.
So yeah, cool move, big attention, but this is exactly where you separate clean continuation from late buyers getting trapped.
RX is a totally different animal. Pull this up and you can feel it immediately. 1953, up 43.5%, but it's a 2.2 billion market cap financial services name, not a tiny float microcap runner. Volume still huge, 41 million shares, 34 times normal, but the tape is cleaner. The level I care about is 1950. That's the gap hold area. That's the line where you find out if institutions are still defending the move or if it just drifts back into the morning range. Above 1950, structure's intact. If it starts living below that, then the whole deal-style gap loses some shine, and you watch for digestion instead of chasing strength. Curry now. This is the earnings-driven one, and it's a way different read than the pure squeeze names. 401 on the print, up about 43%, 14.6 million shares, almost 30 times relative volume. So the volume is real, but the question is quality. Is it actually accepting above 4, or is it just digesting the first earnings pop? Flip it against ARX for a second. ARX had that cleaner, higher-priced, more composed look. Curry's smaller, lower-priced, and it's sitting right on the big psychological level. Back on Curry, $4 is the line for me on continuation. If it keeps building candles above that, okay, buyers are still hanging around. If it can't hold acceptance there, then it's not dead. It's just digestion. And that's a very different trade tape than chasing the first rip. Thanks, Markets Desk. Quick stock whisperer check-in on the simulated paper book. We just opened NVDA long, 40 shares. Average price 224.7486, and it's basically flat right now at 224.7379, down 43 cents on the position. So no victory lap, no panic, just execution. The setup is pretty clean. NVDA is catching the AI infrastructure financing catalyst, and the tape is rewarding GPU compute demand stories today. QQQ is up over 1%, so the market is actually giving this theme some room. My trigger to confirm this is 228.50 above. Risk is defined. Stop is sitting at 219.40. Take profit is up at 236. This is the show's simulated paper portfolio, not something to copy. I'm just showing the thesis, the level, and the risk. Rest of the book, fast. F is steady, 600 shares long from 1385, marked 1397, up about $72. SMCI is the other AI demand piece, 180 shares from 41.7687, now 41.85, up about $15. Bracket is 44.80 above and 41.15 below, and I still want 42.75 for real confirmation. PLTR is the weak one, 35 shares from 174.87, now 173.99, down about $31, with protection at 173.20. Riot is green, 300 shares from 20.28 to 20.41, up $39, bracketed 23.50 over 19.75. USO short is working best right now,
short 80 from 124.82, marked 123.57, up about 100, with a cover order down at 119.50. Cash is still about 51.6K, so we're not overextended. Coming up, we'll kick it back to the movers board.
Thanks, Stock Whisperer. Quick pit stop from the markets desk, because this is the dashboard we're using all show. Right here, ProTerminal's movers board. Top gainers, top losers, price, percent move, relative volume. The stuff that tells you where the tape is actually hot. Look at XHG sitting up over 300% with monster relative volume. That doesn't mean buy it. It means, okay, attention goes here first. Then we do the work. And this is the part I care about before anyone starts chasing a runner. Dilution. Oof. This is where a lot of small cap moves get dangerous. Shelf registrations, ATMs, offerings, warrants. All that supply risk can change the whole read. ProTerminal puts that in one place, so you're not just staring at a green candle and guessing. It's still research. Data can be incomplete or delayed sometimes, so you use it as context, not as a magic button. Now pull up a name's profile and you can dig into the paper trail. Filings first, because that's where the real risk language lives. Then insider trades, news, company details, the whole stack. I'm not trying to memorize every line live on air. I want the red flags fast. Recent offering, shelf sitting there, insider activity, fresh press release, boom. Now the chart move has context instead of just noise. Then we finish where the market's desk lives, the 1-minute chart. Same ticker, same move. Now we're looking at candles, volume bursts, wicks, failed pushes, VWAP behavior, all of it. That's the workflow. Movers board finds it, dilution and filing sanity check it. The chart tells you how traders are treating it right now. If you want the same setup we're using on screen, go to proterminal.io. Proterminal.io. Educational tool, not a trade signal. All right, coming up, we're right back into the movers scan.
All right, markets desk back on the movers board. Let's see what's actually got heat right now. And oof, top row is not subtle. XHG up 332%, almost 59 million shares, relative volume over 4,000. That's not normal activity. That's a full-on liquidity event. Right under it, FGI still up 146 with huge volume. DFSC up 83. LIMN still trading like a slot machine under 20 cents. And GXAI hanging around plus 47. Market backdrop matters here too. QQQ is strong. SPY green, but breadth is mixed. So these aren't broad market drifts. These are individual tapes doing their own thing. We're going straight to the 1-minute charts, starting with XHG. Because that's the board leader, and it's the cleanest scoreboard name right now. Okay, XHG on the 1 minute. This is the monster. $3.96, up 300+%, 58.8 million shares already, versus an average volume around 14,000. That relative volume number, 4,095, is insane. But here's the thing with these. The move is already enormous, and the data showing high dilution risk with a tiny market cap. So this is not a chill chart. This is speed, spread, and trap risk. The first fight is right here around $4. If XHG can actually accept above 4, not just wick it, actually hold bids there, then the momentum crowd stays interested. If it loses that 360 area, I treat that as the air pocket warning, because these runners can give back candles brutally fast. So for the market's desk scoreboard, XHG, watch $4 above and 360 below. Clean levels, no hero stuff. FGI next, and this one's a totally different kind of crazy. We're at 1164, still up about 146%, almost 59 million shares traded, and the float on the board is only about 520,000. So yeah, this can move violently. The clean read for me is $12. Not the earlier level, not the headline percent, 12. If this chart starts accepting above 12, then the post-spike buyers are still in control. If it keeps tagging that area and slipping back under, that's where the fade risk starts to build, because after a move this extended, late buyers can get trapped fast. I want to see candles hold near the highs, not just one wick through and rejection. Now DFSC. Pull this one up. Aerospace and defense name. 227 on the board. Up 83%. And the volume is massive. About 69 million shares. 120 times normal. This is the reclaim getting tired chart. Low twos matter here. If 220, 225 keeps holding, okay, buyers are still defending the prior breakout zone. But if it starts living under that shelf, especially after this much volume, then the move can get heavy quick. This isn't the same vertical insanity as XHG, but it's still a small cap tape. You want stabilization, higher lows, and real bid support, not just one bounce candle and then dead volume. MINN now. And this is where you slow the brain down a little, because yeah, it's up about 60%, but it's a 17-cent biotech with 384 million shares traded. That's not normal volume. That's a whole different game. Relative volumes over 1,200, floats around 33.5 million, and dilution risk is flagged high. So this is exactly the kind of name where the candles can look awesome for 5 minutes and then just trap everybody. For me, the quick read is simple. 17 cents is the line I'm staring at on the 1 minute. If it keeps accepting above there and chewing through offers toward 18, fine. Momentum is still alive. If it starts living back under 17, that's where this can turn from runner into rug pull really fast. GXAI next. AI/gaming name 128, up 47%. 63 million shares, and the relative volume is wild, at about 400 times normal. This one's cleaner than LIMN price-wise, but it's still a small cap momentum tape with high dilution risk. So I don't want to hear AI and just turn the risk filter off. The level's still that 130 area. That's the proof zone. If buyers can actually hold it above 130 instead of just poking through and fading, then you've got a better momentum look. But if it keeps rejecting there, then it's just churn under resistance. And on these names, churn can get ugly fast. RX is the contrast name on this board. Totally different animal from the microcap chaos we've been staring at. Pulling it up now. Accelerant, Insurance Brokers, NYSE name, 2.2 billion market cap, 67 million share float, and it's still up 43% around 1950 on 43 million shares. That's not the same feel as XHG or FGI with tiny floats going nuclear. This looks more like an earnings-driven institutional repricing. Steadier tape, bigger liquidity, and the level I'd keep on the screen is 1950. If it's holding above 1950, the earnings bid is still intact. If it starts losing that and VWAP rolls over, then it becomes more of a cleanup trade than a momentum leader. Now quick downside check. LESL is ugly, 75 cents down 43%, and when a former retail name is trading sub $1, you respect the damage. FGL 47 cents down about 40%, but volume is actually under its average, so I'm not reading that the same way as panic capitulation. Curry is the cleaner late board gainer, 389 up 39%, 15 million shares, that's real liquidity for that name. And HCTI 166 up 34%, but tiny market cap, high dilution risk, so don't let the green candle hypnotize you. Big takeaway from this scan, QQQ's up about 1.25, SPY's green, but the real heat is still in these individual liquidity pockets. Some tradable, some absolute landmines. We'll keep those levels on the board. Coming up, let's shift from the chaos names into the next tape check and see what headlines are actually driving this move.
Thanks. Markets Desk. Breaking news here. FGI Industries just beat Q2 earnings estimates, and this is the headline the desk is tracking right now. FGI reported Q2 2026 earnings of 60 cents a share. Consensus was looking for a loss of 23 cents a share. So yeah, that's not a small beat, that's an 83-cent swing versus expectations. The accountant didn't bring a calculator, he brought a leaf blower. What we know, the EPS number is the story, and the market was already treating FGI like its own weather system. Last movers board print around 11.72. Up about 148%, with relative volume near 183 times normal. What we don't know yet from this wire, the depth of forward guidance, whether the drivers are repeatable, and how much of this is one-quarter shock versus a durable reset. Market read from the macro desk. In a QQQ-led tape, surprises can get rewarded fast. But after the first squeeze, the serious question becomes sustainability. Next headline. Apple and Alphabet are being framed in a race toward a $5 trillion market cap milestone, with two very different forces underneath it. Apple is facing potential pressure from memory chip price swings. That's a cost and margin question. Alphabet, meanwhile, is getting the cleaner AI demand narrative. Why it matters? This is not just mega-cap trivia. This is index plumbing. QQQ's around 732.5, up 1.22%. And when leadership rotates inside the giant tech basket, the index can stay bid even while the internals are messy. Elegant macro version. The market is separating AI beneficiaries from AI cost bearers. Trader version, same party, different bar tab. Third headline. Microsoft is merging its consumer and business Copilot apps ahead of a broader super app rollout. The fact pattern is simple. One Copilot experience instead of separate consumer and enterprise lanes. Why it matters? Distribution. Microsoft doesn't need the AI app to be cute. It needs it sitting in the workflow. Office, Windows, Azure, Teams, all of it. That's the macro angle here. AI is moving from CapEx story to habit formation story. What we don't know yet is user reception or margin impact, and those are the grown-up questions. With VIX still around 1950, the market is not exactly panicking over the AI spend cycle today. Coming up, we'll kick it back to the market mover scan and see which of these headlines is actually getting paid in the tape.
Thanks, Macro Desk. Here at the company desk, let's put TAYD on the earnings board for a minute. Taylor Devices is on today's earnings calendar with an EPS estimate of 89 cents. And I don't have the fresh print in front of me yet, so this is a setup read, not a reaction. Stock's up about 2% in a green NASDAQ tape. But this is not a crazy momentum name right now. This is a small industrial story with a very thin float. So the question is, what would earnings actually change? Okay, look at the 1 minute here. This is a range, not a clean trend. Day high is just over 55. Low is down around 51.38, and right now the tape is kind of hanging in that 53.50 to 54 zone, after bouncing off the low 52s. The important part for me, volume showed up on the push around 51.56, roughly 2,400 shares, and again around 52.46, but the follow-through has not been super clean. So if you're watching this into the earnings window, 54.80 to 55 is the upside line, where buyers have to prove they can actually clear supply. Underneath, 52.10 to 52.30 is the shelf that's been defended. Above 55, the story gets more interesting. Below 52.10, it starts looking like the market is fading the preprint optimism. Now let's get into why this name is even on the radar. Taylor Devices makes shock absorbers, seismic dampers, aerospace and defense vibration control products. Very niche, very industrial, not a software multiple story. The most recent press release we've got is not the earnings print, it's the Farnborough Airshow appearance, their first time exhibiting there. Nice visibility headline, but the company desk question is always, does that turn into orders, backlog, margin, cash flow? The last reported quarter we have, fiscal Q3 ended February, showed about $11.17 million in revenue, EPS of 79 cents, and net income just under $2.5 million. Year over year, revenue growth was 5.8%, EPS growth was 23.4%. So the bar today, with an 89-cent estimate, is really whether margins and demand are still expanding, because the stock already had a big year range between about 40 and 90, and now it's sitting mid-50s. Here's the skeptical part. Balance sheet is clean on the latest data. Zero total debt, about $2.53 million in cash, roughly $70 million in stockholders' equity. That's good. But liquidity matters a lot here. Only about 3.2 million shares outstanding, float around 2.9 million, and average volume is under 30,000 shares. So a post-earnings candle can look dramatic without a ton of institutional confirmation. Dilution page shows no active shelf and no pending S1. But it does flag an active equity line and overall risk as medium, so that stays in the background. Recent insider activity includes April awards and a couple of April sales around the mid to high 50s. Not a thesis by itself, just context. For me, the actual change would be an earnings print that confirms stronger sales, clean margins, and real cash conversion. Coming up, the market mover scan takes us back to the names with the loudest tape right now.
Thanks, company desk. All right, markets desk is back on the movers board, and yeah, this board is still nuts. QQQ's up about 1.3, SPY green, IWM barely green, VIX not doing much, so the index tape is fine, but the real action is single name chaos. XHG still parked at the top, FGI still huge, DFSC, HCTI, LIMN, GXAI, all stacked with monster volume, so we're not doing a lecture here. We're going chart to chart. I want acceptance, I want volume, and I want to see who's still getting bought versus who's just bleeding off the pop. Start with XHG, because this is still the headline burner. Live board had it around 393, up roughly 329%, almost 60 million shares traded, and relative volume over 4,000 times normal. That's not interest, that's a stampede. But here at the markets desk, we keep score with levels. The $4 area is still the proof line. Right now, under 4, it hasn't earned that clean acceptance yet. If it reclaims 4 and actually holds there, okay, buyers are back in control. If it keeps jamming into 4 and rejecting, that's supply leaning on it. And the lower warning is still 360. Lose that, and this thing can get slippery fast. Also, tiny market cap, high dilution risk profile. So I'm reading the tape, not romanticizing the move. FGI is next. And this is the one where I don't want to just stare at the percentage gain and get hypnotized. Yeah, it's still up about 138%, doing 60 million shares, roughly 185 times normal volume. Crazy tape. But on the 1 minute, the question now is whether this earnings runner is cooling under that prior proof zone, or whether buyers actually defend the low 11s. It's around 11.24 on the board, so watch $11. If that area keeps getting bought, fine, the runner is still alive mechanically. But if bounces start getting stuffed, and it starts accepting below 11, that's usually where the character changes from momentum to leak. Tiny float too, about 520,000 shares, so the candles can look amazing, and then slip a buck before you blink. Now DFSC, same idea, different chart. This had the defense tech headline energy earlier, still up about 79%, and the liquidity is real. 70 million shares traded, over 120 times average volume, but the level is super clean here, 225. That was the shelf, and now price is sitting just under it around 221. So this is the spot where I'm watching reclaim versus failed bounce. Above 225 with volume coming back in, okay, buyers are proving they still care. But if it pops into that level and rejects, that's trapped long territory, especially with a name like this where the float is small, about 1.35 million, and the move's already been huge. Don't chase the percentage. Watch whether the reclaim actually sticks.
Thanks, Markets Desk. Quick check-in here at the Stock Whisperer. This is the show's simulated paper trading portfolio, and the fresh line is MU. Long 8 shares, entry 971.95. Last print basically flat at 971.935. The thesis is clean enough for a paper entry. Micron's moving on that manufacturing partnership catalyst. Semis are leading the tape, and QQQ's still firm today, up about 1.15%. So for me, this is not a chase everything setup. It's thesis, level, risk. I'm watching 960 as the first momentum failure line. If MU starts living below that, the continuation idea is getting weaker fast. Now, the bracket is what keeps this honest. The paper stop is sitting at 945, and the take profit order is up at 1045. That's defined risk, not a prediction. On 8 shares, that's about $216 of paper risk to the stop, versus about $584 if the bracket take profit gets tagged. Rest of the book is mixed. F is the small green one. NVDA is basically a paper scratch, and Riot, SMCI, and the USO short are all red right now. No victory lap here. MU has to prove it, and if 960 fails, the Stock Whisperer starts questioning the setup.
Thanks, Stock Whisperer. All right, quick vol check, because the tape is green, but the insurance bill is not exactly getting cheaper. Here at the macro desk, this is the little wrinkle. QQQ is up about 1.1%, SPY up about 0.5%, Breadth is mixed, and VIX is still hanging near 19.6, actually green on the day. That's not panic. Panic is when the dog eats the couch. This is more like traders leaving the umbrella open while the sun's out. Watch the 20 line on VIX. Above there, the market starts telling you demand for protection is still sticky. Below 19, different feel, more of a grind, risk-on tape. And with Fed speakers later plus the 12:30 macro line on the calendar, it makes sense that vol isn't just collapsing while everyone chases the AI beta. Now, pull up SMCI because this is the single name version of that same story. Stocks around 41.9, up roughly 11%, and the 1-minute chart is not subtle. It based around 39.7 to 40, then volume kicked in through 40.7, again through 41.8, and the squeeze topped near 42.30. That's realized volatility. When a stock does a 6-ish% intraday range before lunch, options don't price it like a treasury bill. They price it like a raccoon in the ceiling. No chain data here, so I'm not talking strikes or trades, just the regime. The clean read is 41.50 is the first line buyers have to defend after that pullback. If SMCI loses 41.50, the vol bid can stay loud because the chart gets messy. If it reclaims and clears 42.30 with volume, that's the upside proof zone where chase flow usually gets tested.
Thanks, Macro Desk. Let's pull up CBRG, because this chart is messy in the fun way. Alright, Markets Desk on the 1 minute, early push, big volume, then oof, full fade. We've got the tape basing around $4.90 to $4.95 now. And that matters, because the high was up near $5.45. So this isn't clean strength. This is a runner that already got hit. Look at that structure. The first leg was real. Volume came in early. Candles lifted from roughly 513 up toward 545. Higher highs, higher lows, buyers were absolutely there. But then the sellers answered. Same thing on the way down. Not a quiet drift, not some low volume nap. The decline back under 5 happened with elevated volume too. That's why I'm treating $5 as the line. Above 5, you can at least say buyers are trying to reclaim the breakdown area. Below 490, that little base cracks. And then the tape is telling you the fade is still in control. Not a recommendation, just the scoreboard. 5 reclaim, 490 failure. Now catalyst check. I'm going over to the company news feed, and from what we've got here, there are no fresh press releases showing for CBRG. So if you're wondering, hey, is this an obvious headline trade? I don't have that in the feed. The profile is also important. Chainbridge I is basically a shell company, a SPAC-style setup, looking for a business combination, with a stated focus around tech tied to national security and intelligence interests. So the move is all about tape and speculation, unless a fresh filing or headline hits. One more thing, and this is the part small-cap traders can't skip. Dilution center. CBRG shows no active shelf and no pending S1 in the data here, but it does show an active equity line, 7 total offerings historically, and runway around 1.7 months. Overall risk is marked unknown, but that cash needs score is not something I'd ignore. So back on the chart, the read is simple. $5 is the reclaim test. $4.90 is the base. If it sits between them, it's chop. If volume comes back through one side, that's when the next move tells you something. Coming up, we've got a quick pro terminal hit, so we'll show the workflow behind pulling this stuff up fast.
All right, quick reset. Everything the Markets Desk is using on these fast movers is right here in Pro Terminal. This board is where we're catching the names that are actually moving, not random chatter. XHG up top, FGI, DFSC, GXAI. You can see price, percent move, relative volume, the whole first pass scan. And key point, this is research context. It's not a buy button. Now, flip from the board straight into the chart. This is why I like keeping it tight. One click, we're on the 1 minute tape. You can see where the volume hit, where the wick rejected, where the bid actually tried to hold. Oof, look at that kind of move. That's exactly why we keep talking levels. The chart tells you when the headline move is getting confirmed and when it's just noise. And then, this is the part people skip, dilution. especially with small caps and momentum names. Before you fall in love with a candle, you want to know if there's a shelf, an ATM, an offering history, anything that can change the supply side of the stock. ProTerminal's Dilution Center puts that risk right in front of you. Not to scare you out of every trade idea, just to keep score honestly. Risk is real, data can be incomplete or delayed, and tiny names can change fast. Last one. Filings, news, insider tabs, all on the stock profile. This is where you check the actual paper trail instead of guessing why something's moving. Press releases, SEC filings, insider activity, it's all part of the research stack we're using live on the show. If you want the same setup, it's ProTerminal. Sign up at proterminal.io. Coming up, we've got Earnings Spotlight next, so we'll put these tools right back to work. Thanks, Markets Desk. Let's put the earnings lens back on TID. All right, Company Desk here. And this is a very different kind of move than the wild small cap board names. TID is around 54.45, up just under 2%, while QQQ is up almost 1% and breadth is mixed. So the question is not, is this thing exploding? It's not. The better question is, are traders positioning for an actual earnings confirmation? Or is this just drifting around while we wait? On the 1 minute, you've got the early pop that failed, the washout, and now a late morning crawl back into the upper half of the day's range. Constructive, yeah, but not decisive yet. Here's the earnings setup. Calendar has TAWI reporting today, unscheduled time, with an EPS estimate of 89 cents. Important distinction, I do not see a fresh earnings release crossed in the feed yet, so this is still setup mode, not reaction mode. The latest reported quarter in the data was fiscal Q3, about $11.17 million in revenue, 79 cents of EPS, and roughly $2.5 million in net income. Year over year, revenue growth was 5.8%, EPS growth was 23.4%. So the bar is pretty clear. The street is not just asking for steady. That 89-cent estimate is asking for a step up from the last quarter. And for a company like this, the story has to be margin, backlog, and cash conversion, not just a nice headline number.
Thanks, Company Desk. Breaking macro headline just hit. U.S. durable goods orders rose more than expected. ProTerminal's newsroom is tracking a stronger rebound in orders, with the lift tied to business investment in defense and machinery. So what do we know? The headline is growth positive. It points to some resilience in industrial demand, and it matters for capital goods names because this is real economy spending, not just stock market confetti. What don't we know yet? We don't have the full component table or the revision details on this card. So I'm not going to make up a magic decimal and pretend it came down from Mount Macro. Market read right now, SPY is around 775.9, QQQ 730.8, both green. But VIX is still 19.56 in green too. That's a market saying, nice growth data, but keep the umbrella nearby. Next headline. Fed officials are signaling the interest rate hold may extend. The desk is seeing the same cautious message again. Policymakers want clearer disinflation before easing. Why it matters is pretty simple. If rates stay higher for longer, long-duration growth stocks have to keep earning the premium they're trading at. Because the discount rate math doesn't take lunch breaks. Cross-asset color is a little interesting here. TLT is at 82.67, up 0.68%, IEF is up 0.42%, and the dollar proxy is slightly lower. So bonds are not throwing a tantrum off this headline, at least not yet. Here at the macro desk, that's the wrinkle. Fed talk is hawkish, but the tape is not pricing panic. Third one. Oil prices are in focus on Middle East supply disruption fears. The headline issue is shipping lane risk and potential supply interruption. And that matters because energy is the bill that eventually shows up everywhere. Transportation, chemicals, airlines, consumers, margins, the whole boring spreadsheet parade. The live cross-asset board has oil around 126.06, down 0.97% right now. So the story risk is elevated, but the intraday price is not screaming higher at this second. Gold is softer too, around 400.56, down 1.08%, which tells you this is not a clean hide and safety tape. Coming up, sector theme spotlight should be a good one, because this macro backdrop is exactly where sector rotation starts acting like a shopping cart with one bad wheel.
Thanks. Macro desk. All right. Markets desk, grabbing the movers board. And yeah, the tape is greenish. QQQ up about 1%. SPY up 0.5%. IWM barely green. But breadth is mixed, and VIX is still green too. So these single name rockets, that's not just an easy everything ribs tape. Top of the board. XHG, oof, up 281%. 61 million shares. Over 4,000 times relative volume. Then FGI up 138. DFSC still hanging around plus 90 after that earlier 225 fight. GXAI plus 56. LIMN still a massive volume penny name, and LESL is the ugly downside move. Board first, then we go chart by chart. Levels only. No wasted motion. Let's pull XHG first, because this is the loudest thing on the board. Price is around 349, up 281%, and the board is showing 61 million shares traded against average volume of basically nothing. Relative volume, 4,247 times. That's insane. But here's the catch. Market cap is only about 4 million, shares outstanding just under 1 million, and the float feed is showing a microscopic 415 shares. If that feed is even close, this is air pocket liquidity. So I'm not treating this like a clean fundamental re-rate. This is pure speculative momentum. On the 1 minute, 350 is the first battle line. Above 350, buyers are still trying to control the tape. If it can't hold that and starts rejecting, watch how fast the bid thins out. Bigger downside line for me is $3. Lose 3 after a move like this, and that's where the runner can turn into a trap real quick. Also flagged high dilution risk. So yeah, read the chart, respect the volume, but don't pretend this is normal. FGI next. And this one's cleaner than XHG in the sense that you've actually got an earnings beat momentum story underneath it. Stocks around 1128, up about 138%, and the volume is just ridiculous. 62 million shares versus a normal day around 326,000. That's almost 192 times relative volume. So, on the 1 minute, I'm watching the $11 area really closely. If candles keep accepting above 11, meaning dips into that zone get bought and it doesn't instantly reject, then the tape still has momentum buyers hanging around. If 11 starts acting like a ceiling instead, that's where this can turn into a pretty nasty chase trap. Float's only about 520,000, so yeah, the moves can be violent both ways. Now back to DFSC for the scoreboard, because that 225 level we flagged, yeah, it hit. Price is sitting around 235 now, still up basically 90% on 72 million shares, so the reclaim is real enough to respect, but I don't want to see buyers lose 225 immediately after the hit. That's the difference between a clean reclaim and a fake out. Above 225, momentum traders can argue it's holding the prior breakout zone. Below it, you probably get that air pocket feel where the late chasers start bailing. GXAI now, and yep, that 130 level from earlier got tagged, so scoreboard gets another checkmark there. This is the AI/gaming squeeze name, Gaxos.ai, around $136, up 56%, 67 million shares, and relative volume over 400 times normal. That's real attention, no question. But here's the catch. Dilution risk is marked high, so this is not a name I'm treating like some clean institutional breakout. On the 1 minute, the quality check is simple. Can it keep accepting above 130? Or was that just the squeeze line where late longs get trapped? If the pullback stays shallow and volume keeps coming in on the pushes, fine, momentum's still alive. If it loses 130 and starts printing lower highs, that's when the AI buzz can turn into a rug pull fast. Now flip it to the ugly side. Lesl. This is Leslie's, sub-dollar now, about 74 cents, down 43% on the day. So while QQQ's green and the tape's got some risk on pockets, this is the opposite. Selling pressure that's not waiting for the market to give it permission. Volume's about 4.1 million, Relative volume 21 times normal, so it's not quiet selling either. The read here is whether it's controlled liquidation or still expanding. If the 1 minute is just stair-stepping lower, bounces failing under the prior breakdown area, that's still pressure. If it starts basing and the red volume dries up, okay, maybe the flush is maturing. But under $1, every bounce is suspect until it proves otherwise. I'd have 70 cents on the downside radar, and that 75 to 80 cent area as the first real battle zone. One more pass before we hand this board off. ARX is kind of the adult in the room here. This isn't the $4 million microcap circus. Accelerant sitting around 1953, up about 43%. NYSE name, roughly 2.2 billion market cap, and it's still doing 45 million shares with almost 38 times normal volume. So in a tape where QQQ's green, but breadth is still kind of mixed, that relative strength matters. The line I'd keep on the screen is 1950. Above that, this still looks like buyers are accepting the higher range. Below it, you can see these clean liquid movers cool off fast once the momentum crowd backs away. Now quick flip to the bottom side. FGL is the fade, 47 cents, down 39%, but the relative volume's only about 0.47, so that's not the same emotional blowout as some of the runners. It's more just no real bid showing up. And then Curie is the cleaner media strength on the other side, 390-ish, up 39%, 16 million shares, 33 times normal volume, and pressing right into that $4 round number. So that's the movers board. XHG was chaos. FGI had the cleaner earnings push. DFSC and GXAI paid those levels. LESL and FGL were the ugly fades. And ARX Curie are the better liquidity reads. Coming up, let's rotate into the sector theme spotlight and see if there's an actual group move underneath these standouts.
Thanks, Markets Desk. Let's flip from the movers tape into the AI semiconductor basket. Tiny housekeeping right away. The theme label in the feed is talking oil and Middle East supply risk. And yeah, energy costs matter for data centers. But the names loaded here are NVDA, AVGO, MRVL, and AMD. So here at the company desk, I'm treating this as the real question. If AI factories get more expensive to finance and power, does the chip group still get paid? QQQ's up just over 1%. SPY's green, breadth is mixed, so semis should have a pretty clean stage here. Start with NVDA, because it's still the center of gravity. The stock's around 224.88, up about 1/3%. So it's green, but it's not exactly running away from the Nasdaq today. And that matters. When the headline story is this big, AI gold rush, data center financing, Blackwell capacity, compute shortages, you'd expect the leader to show obvious relative strength. Instead, it's participating, not dominating. The company read is fascinating though. NVIDIA isn't just selling the shovels anymore. The market is debating whether it's selling chips, enabling financing, helping create demand, and maybe even supporting a secondary market for older GPUs. That can be brilliant if the ecosystem keeps growing. It can look circular if customers are relying on the same financing loop to keep buying. Look at the actual company breadcrumbs. We've got fresh NVDA tag news today talking about NVIDIA playing multiple roles in the AI buildout. And another piece focused on this huge $500 billion data center plan with names like Apollo, BlackRock, Blackstone, Brookfield, Goldman, and KKR in the conversation. Then you've got the skeptical side too. Michael Burry-style criticism calling the AI spend cycle a circular financing web. So the trade is not just chips are good. The business question is, does this expand the total market, or does it pull demand forward with more leverage in the system? That's why I don't want to just cheer the headline. At 55 times trailing earnings with a market cap over 5.4 trillion, the story has to keep converting into real orders, real utilization, and real cash flow. Back to the tape on NVDA, because the chart is where the story gets judged. Current price is basically sitting just under that 225 area. And that's the clean line I care about for this segment. Not a price target, just a sentiment check. If NVDA can get accepted above 225 while QQQ stays firm, that tells you buyers are willing to pay up for the AI infrastructure story, even with the financing debate hanging over it. If it keeps stalling under there, then the headlines are interesting, but the tape is saying, show me. And the longer-term reference is still that 236.54 yearly high sitting overhead. Not today's battle, but it's the ceiling everyone can see. Now, rotate the group. AVGO is the custom silicon and networking read. When hyperscalers want specialized AI hardware, Broadcom is one of the cleanest public ways the market checks whether that spend is broadening beyond NVIDIA GPUs. So if NVDA is the king of the GPU stack, AVGO is the "are cloud customers building their own lanes too?" chart. I'm not forcing a number here because the packet is light on AVGO data. But the relationship matters. If AVGO confirms NVDA, this becomes a broader AI CapEx story. If AVGO lags badly, the market may be treating today's headlines as more NVIDIA-specific, or maybe even more speculative than structural. Marvell and AMD are the next two checks. Marvell is more of the networking, connectivity, custom silicon angle, the plumbing behind the AI factory. AMD is the challenger story. Can customers diversify accelerated compute, or does NVIDIA keep absorbing the premium multiple? That's the arc here. Oil and power costs may be the macro pressure in the background. But the company desk question is simple. Does AI infrastructure spending still look durable enough to lift the whole chip basket, not just one stock? Coming up, Megacap Watch should be a good handoff, because this theme really lives or dies in the leaders.
Thanks, Company Desk. All right, Markets Desk is grabbing TSLA on the daily. This is not the small cap circus, this is the mega cap liquidity read. Tape's green, QQQ up almost 1%, and TSLA is up a little over 2%. So yeah, it's showing some relative strength. But look at the bigger frame. Daily chart is still a base after a pretty nasty reset. We had that prior run toward the mid 440s, then lower highs, lower lows, and now we're living down here around 320 to 335. Oof. This is a repair chart, not a clean trend yet. Here's the score. The daily line everyone can see is 335 to 340. That's the near-term ceiling. Price is pressing into it, but it's still below the bigger moving average stack, so the daily downtrend hasn't magically disappeared. If TSLA can actually accept over 335.40 and not just wick it, then the base starts looking healthier. If it keeps rejecting this zone, you're back inside the range. And underneath, daily support near 320 is the line that keeps the whole base from turning ugly. Recent push is fine, but it's not monster confirmation. So here at the Markets Desk, 335.40 above, 320 below. Let's drop down to the 1 minute, because this is where the trade tells on itself. Intraday range is tight, roughly 332.40 low to 335.38 high, but the important bar was around 1037. Big volume spike, over 260,000 shares, pushes it into that 335.38 high. That's real demand showing up. Then, no follow-through. It pulls back, doesn't puke, and starts flagging between about 333 and 334.80. That's constructive, but it's also chop. Right now, those last candles are basing around 333.4, so I'm not calling this a runaway move. It's a flag after a pop, with volume fading. The quick read. Above 335.40 with volume, TSLA starts leaning back into that daily ceiling. Below 332.40, this little flag is failed breakout risk, and you start looking back at the lower end of the intraday range. In between, mid-range noise. And the VIX being green while QQQ is green still matters. Protection's not dead. Fed hammock hits in about 20 plus minutes too, so mega cap beta can get twitchy. Coming up, we'll hit small cap momentum and see if the runners are still paying or trapping. All right, let's hit the small cap tape. IVDA is the one blinking on the board right now. Here at the Markets Desk, this is exactly the kind of chart where you keep it tight. 49-cent stock, tiny market cap, about 5 million float, and volume already over 113 million shares. Oof, that's not normal traffic. Market's green, QQQ's firm, but breadth is mixed. So this isn't just beta. This is flow hitting a little name. Okay, look at the actual 1 minute structure. IVDA opened around 47 cents, dipped early, and then really found that ugly low down around 44.3 cents. For a while, it was just chopping. Lower highs, lower lows, hanging around 45.5 to 46 cents. Then bang! Around that later push, it goes from roughly 46 cents up through 50, tags 50.6 cents, and the volume confirms it. There's a candle near 49.9 cents with about 1.25 million shares. That's the candle that changed the character. Right now it's digesting around 49, still above that 48 to 49 support pocket. The clean scoreboard is simple. Above 50.6 cents, it's trying to prove the breakout is still alive. Below 48 cents, that turns into trap risk fast. Now, flip the headline stack, because with these little ones, I always want to know if there's a fresh catalyst or if it's just tape. I'm not seeing a fresh same-day press release in this feed. The latest visible PR is June 17th, Sleep Sense for Ivita Care, contactless overnight health monitoring for senior living. So unless something newer hits, the move on screen looks way more technical and flow-driven than headline-driven. And then here's the other side of it. Dilution risk is real. ProTerminal's Dilution Center has IVDA marked high risk, active shelf, active equity line, pending S1, and about 19.5 million raised over the last 12 months. So I'm not telling anybody to chase a 49-cent small cap. The tape can be great, and the capital structure risk can still be nasty. Back to the chart, and this is the whole trade read. Not advice, just the tape. If IVDA can hold that 48 to 49 zone and keep building under 50 cents, then 50 and 50.6 become the next pressure points. If it stuffs under 50, curls, and loses 48, that's the failed runner look. We just saw CBRG give us that kind of failure earlier, so keep score. No halt flag showing here, but with a float this small, the candles can move like air pockets. Coming up, we'll hit the news intermission and see what headlines are actually driving this midday board.
Thanks, Markets Desk. Quick newsroom sweep here. And we're starting with ARX. Headline: Accelerant Holdings topped Q2 earnings and revenue estimates. The company posted earnings of 32 cents a share versus the 16-cent consensus. So that's a clean double on EPS, with revenue growth versus last year. Why it matters? This is exactly why ARX has stayed on the active board. The market loves a beat, especially in a tape where SPY is only up about 0.4. But here's the wrinkle. There are also shareholder investigation headlines around the proposed Thoma Bravo transaction. So this is a classic macro desk, two hands on the wheel setup. Better fundamentals on one side, governance noise on the other. Next one, Apple reports fiscal Q3 results, and this is a real index weight story, not just an Apple story. Revenue came in at $109.4 billion, up 16% year over year, and gross margin was 50.1%. That margin number matters because Apple is basically the ballast in the mega-cap boat. When margins hold, the market breathes a little easier. With QQQ up around 0.9%, this kind of print supports the big cap tech tone, and it matters for suppliers, services, buyback expectations, and frankly the whole consumer tech read-through. All right, top of the hour, 12:01 Eastern. Welcome in if you're just joining us. This is the macro desk with the quick market reset. The tape is green, but not exactly throwing a parade. SPY around 775.4, up about 0.4. QQQ doing the heavy lifting at 730, up almost 0.9, while IWM is basically flat at 302.9. So that's your story right there. Big cap growth is driving. Small caps are just kind of standing in the doorway holding their coat. VIX is still up at 19.57. So even with stocks higher, the risk thermostat has not really cooled off. Bred this mix too, which means this is not a giant everything rally. It's more selective, more NASDAQ-led, more show me the quality and the liquidity. The cross-asset read backs that up. Bonds are bid. TLT up about 0.6 at 82.60, IEF up 0.4 at 93.32. So rates are not fighting the equity bounce right now. Dollar's a touch softer at 28.18, yen's a hair firmer. Gold is actually getting hit. GLD down 1.16% near 400, and oil is softer too. USO around 126.70, down 0.5%. Translation: the market is saying growth is okay. Inflation panic is not the main character this minute. But volatility didn't leave the building. Earlier, the macro desk flagged stronger durable goods as part of the backdrop. And today's calendar still matters. Fed hammock at 12:15, claims and PPI on the sheet at 12:30, Barkin at 12:40. What I'm watching from here, QQQ holding that 7:30 area, VIX pressing toward 20, GLD at the 400 line, and whether oil stays heavy despite the headline risk. Coming up, we've got a market mover scan, then the Whisperer update.
Thanks, Macro Desk. All right, Markets Desk is grabbing the movers board right now. QQQ's up almost 1%, SPY's green, but breadth is still mixed, and VIX is green too. So this is not some clean risk-on blanket. This is stock picking tape. And look at the board. XHG up 289%. FGI up basically 196. DFSC still up 78. GXAI up 47. Oof. This is the tiny float, high relative volume part of the market doing the loudest stuff. Also, quick scorekeeping. XHG did tag that 350 level from earlier. It's sitting around 356 now. So now the question is simple. Was 350 a real reclaim, or was that just the squeeze candle into liquidity? Now, XHG first, because this is the headline burner. 356 on the print, up 289%, 62.9 million shares traded, versus an average around 14,000. That relative volume number is absurd, 4,300 plus times normal. And ProTerminal's float field is showing 415 shares, which is basically telling you this is not normal liquidity, this is air pocket trading. So I'm not chasing the headline here, I'm watching the structure. 350 is the line that matters now, because it already triggered. If this thing starts losing 350 and can't reclaim it, that's where the squeeze can turn into a rug pull chart real fast. Above it, the next obvious magnet is the $4 round number, but only if volume stays aggressive. High dilution risk is on the board too. So yeah, fun chart, dangerous chart. FGI next. And yeah, this one is not as cartoonish as XHG, but it's still a monster. We're sitting right around 1398, up basically 195%, and the tape is heavy. 68 million shares through it already. Relative volume over 200 times normal. So the line I care about here is simple, 14 bucks. If this thing can keep accepting above 14 after that squeeze, the bid is still alive. If it keeps tagging 14 and rejecting, then you know traders are using that whole number level to unload into strength. Also, medium dilution risk on the board. So I'm not treating this like some clean institutions-only move. It's a squeeze tape. It's liquid, but that 14 area is the tell right now. Now, DFSC. We already hit the story side earlier, the defense/government digitization angle, so I'm not going to rehash the headline. Just tape. This is still strong, 221-ish, up 78%, 73 million shares, relative volume 127. But look how different this is from the pure insanity names. DFSC is trading like a stock trying to decide if 220 is acceptance or a ceiling. That 220 area matters, because if buyers keep stepping in there, you've got a cleaner consolidation look. If it loses that and starts living underneath, then the whole move starts feeling more like a midday fade than a fresh push. Medium dilution risk here too. So again, respect the liquidity, don't romanticize the chart. GXAI now. And this is the one where the earlier 130 breakdown actually matters. We're at about 128, still up 47%, so it's not like the move disappeared, but the tone changed when it lost that 130 shelf. 69.7 million shares, 443 times relative volume. That's insane participation, but massive volume cuts both ways. If it pops back over 130 and holds, okay, the reclaim is real enough to keep watching. If it keeps rejecting under 130, then this is just heavy tape with trapped momentum above. And remember, high dilution risk on GXAI too, so I'm reading the chart first here, not falling in love with the AI label. LIMN next. And this one's a pure penny biotech liquidity fire hose. 15.7 cents on the print, up about 45%. But look at the volume. 447 million shares traded. Relative volume almost 1,500 times. That's not quiet accumulation. That's the entire day trader universe passing this thing around. Under 20 cents, this is fragile by default. And with high dilution risk, you have to treat every spike like it can rug back into VWAP fast. The levels are pretty simple. Can it keep accepting above 15 cents? And can it actually pressure toward 20 cents without stuffing? If it starts losing 15, that tells you the liquidity was there, but the bid wasn't sticky.
Thanks, Markets Desk. Quick paper portfolio check here at the Stock Whisperer. This is the show's simulated 100K paper book for the broadcast, not a copy this setup. Cash is sitting around 49.2K, and the open book is slightly right overall. Ford is the calm one. Long 600 at 13.85, trading 13.906, up about 34 bucks. Nothing heroic, but it's doing its job. MU is the one I'm watching more closely. Long 8 at 971.95, now 967.28, down about 37. It cracked that momentum line earlier and bounced back a bit, so the thesis is not dead, but it has to prove itself. NVDA is basically flat. Long 40 at 224.75, trading 224.78, up $1. That's not a win, that's just a position waiting for confirmation. Now, the risk side. Riot is long 300 at 20.28, trading 20.10, down 54 bucks. Crypto equity names can move fast, so I'm not giving that one extra rope just because the market's green. SMCI is long 200 from 40.755, now 40.665, down 18. That one was the AI infrastructure guide shock setup, and the line for me is simple. It needs to start accepting above 42, otherwise it's just noise under the news. USO is the problem child on the blotter. Short 80 from 124.82, now 126.115, down about 104. That's the biggest open loser in dollars, so I'm not sugarcoating it. The short is against us right now. Flipping to orders, the brackets are clean on SMCI, MU, NVDA, and Riot. SMCI, take profit 45.50, stop 38.90. MU, take profit 10.45, stop 9.45. NVDA, take profit 2.36, stop 2.19.40. Riot, take profit 23.50, stop 19.75. F and USO do not show attached open bracket orders in this blotter, so those are the names I'm treating with extra risk attention, not new capital.
Thanks, Stock Whisperer. Quick macro check into PPI. All right, here at the macro desk, the story is pretty clean. Stocks are green, but not in a totally carefree way. SPY's up about 0.46%, QQQ's doing the heavy lifting up 1.06%, and the Russell's only up 0.17%. So this is still a NASDAQ-led tape, not some huge everything rally. And the tell? VIX is actually up a touch, 19.57, up 0.62%. That's the market saying, yeah, I like tech, but I'm keeping the helmet on. PPI hits at 12:30, with headline month-over-month expected at 0.2% and core expected at 0.3%. So the next 20 minutes are basically the warm-up lap. Everyone's trying to decide if inflation is finally behaving or if it's the house guest that somehow found another suitcase. Cross-asset positioning is the interesting part. Bonds are bid into the number. TLT at 82.595 up 0.59%, and IES at 93.319 up 0.39%. That usually means yields are easing a bit, which is why QQQ can wear the crown today. Softer dollar too. The dollar proxy's down 0.07% at 28.18, while yen's a little firmer at 57.57. Gold, though, is not getting the safety bid. GLD's down 1.16% at 400.21, and oil's softer too, off 0.47% at 126.70. So this is not classic panic positioning. It's more like bonds are bracing, tech is hopeful, commodities are cooling, and volatility refuses to leave the room. My radar into 12:30 is simple. VIX around 20, QQQ around that 730 support pocket, TLT holding 82.50, and the dollar around 28.20. If those all start moving together after PPI, that's when the macro dominoes start talking.
Thanks, Macro Desk. Quick tool hit, because this is the stuff we're using all day. This is ProTerminal's Dilution Center. And yeah, for the small cap runners, this page matters. Shelves, ATMs, offerings, financing language. It's not drama, it's supply risk. Before the chart gets loud, here at the markets desk, I want to know if new shares can hit the tape. Research first. Trade button later. Now flip to the movers board. This is the triage screen. QQQ's green, breadth is mixed, so I don't just want index beta. I want the names actually doing something. Gainers, losers, price, relative volume, all in one shot. Look, this is not by the top row. Absolutely not. It's a scanner. Who's abnormal? Who's liquid? Who's fading? Who deserves a real chart read next? Then you click into the name and go down the rabbit hole. I'll use XHG as the demo because it's sitting on the board. News first. What's the catalyst, if there is one? Then filings. Oof, this is where you catch registrations, warrants, financing terms, the stuff that changes the risk profile fast. Then insider data. Same idea. Ownership context, transaction filings, what's actually been reported. And with tiny names, feeds can be messy or incomplete sometimes. So you use the data as context, not gospel. And last stop, the 1-minute terminal chart. This is where the tape either confirms the story or smacks it down. Candles, volume bursts, nasty wicks, VWAP-style areas, all right there while the move is happening. Everything you've seen us use, movers, charts, dilution, filings, insider trades, news, that's ProTerminal. This stream is educational, risk is real, and nobody's getting handed a magic buy button. If you want the same dashboard on your screen, sign up at proterminal.io.
Thanks, Markets Desk. All right, macro lens on the whole tape for a second. The headline looks friendly. SPYs at 775.81, up 0.43%. And QQQ is doing the heavy lifting at 731.03, up just over 1%. But here's the little wrinkle. IWM is basically flat at 302.93, and VIX is not asleep. It's 19.63, up about 0.93%. So yeah, Nasdaq's green, but the market's still wearing a helmet. Here at the macro desk, that usually reads as narrow leadership. Mega cap growth is carrying the backpack. Small caps are walking behind it, and volatility is hanging around like it paid rent. The existing scoreboard lines still matter. QQQ holding around 730 keeps the tech bid intact. VIX pushing toward 20 would tell you the tape is getting more defensive, even if the index screen still looks green. Now, the Y is over in rates and the dollar. Bonds have a bid. TLT is 82.595, up 0.59%, and IEF is 93.319, up 0.39%. That's duration getting bought. And when duration gets bought, long growth stuff, your Nasdaq complex, tends to breathe a little easier. But the dollar isn't doing some dramatic faceplant. UUP is 28.18, just down 0.07%, basically parked right under that 28.20 line. So this is not full risk on confetti. It's more like the market saying, rates relief, yes please, but let's keep one eye on the exits. Gold tells the same story. GLD's around 400.21, down 1.16%. While oil is 126.7, off 0.47%. That's not panic buying safe havens. That's a softer commodity tape with bonds acting as the safety valve. And crypto's mixed. BITO slightly green, MSTR up 0.85%, coin down 0.93%, so the speculative lane isn't giving one clean all clear either. Okay, now calendar risk. Keep this on the screen for a second. We've got Fed Hammock at 12:15, then that 12:30 ET block with PPI and jobless claims. So the next little test for this rally is pretty simple. Do rates stay heavy? Does the dollar stay soft? And can Nasdaq keep leading without breadth really kicking in? Because right now, QQQ's the cleaner leadership piece. Up about 1% on the tape, but VIX is still 19.63, so it's not like vol is dead. My radar levels from here. VIX 20 is the mood line. Above that, and the tape gets a lot less chill. QQQ 730 is the intraday support I care about. Lose that, and the nice headline strength starts looking more fragile. TLT 8250 matters because bonds are holding a bid above it right now. And UUP 2820 is the dollar line. Back above that, I'd expect tech leadership to get tested a bit. So yeah, friendly tape, but not a victory lap tape yet. Let's hand it over to Mega Cap Watch, because if this NASDAQ move is real, the generals should be telling us immediately.
Thanks, MacroDesk. Let's pull up Amazon, because this is the kind of mega cap lag that matters. QQQ is still green, close to up 1%, and AMZN is slightly red on the day, quoted around 266.74. So right away, here at the markets desk, that's the headline. Not disaster, but not leadership. Daily chart first. Look at the structure. AMZN had that clean push from roughly the low 220s up into the 275, 278 area, and volume actually showed up on that move. Spikes above 90 million shares during the rally. That's real participation. But since then, it's been chop. Lower highs near that 278 zone, little dips back toward 265, and the recent candles are smaller with lighter volume. So the daily is not broken, but it's range-bound. For me, the scoreboard is simple. 265 is the support shelf. 278 is the ceiling. If AMZN starts losing 265, that daily base gets heavier. If it can reclaim 278 with volume, then the range finally changes character. All right, let's drop down to the 1 minute. Oof, look at that wick and fade action. This is not matching the broader NASDAQ bid. AMZN opened around 268.22, tagged up near 268.34, and then it's been a staircase lower. Lower high, lower low, pause, lower again. The intraday low in the read is around 264.91, so it basically pressed right into that 265 daily zone we just talked about. And the important part, volume confirmed the selling. There was a heavier flush around that 265.87 candle with volume north of 250,000 shares. So this wasn't just a lazy lunchtime drift. The reclaim level I care about intraday is 268.10. Above that, you can at least argue buyers are trying to repair the tape. Under that, it's still a downtrend on the 1 minute.
Thanks, markets desk. Breaking across the macro tape right now. ProTerminal's newsroom is tracking 3 U.S. Fed officials dissenting and calling for an interest rate hike to better fight inflation. What we know, this is a hawkish dissent from the current policy stance, and it's 3 officials, not one lonely inflation hawk yelling at the toaster. What we don't know yet, the full language, how hard the broader committee pushes back, or whether this becomes the center of policy. Market read quick. SPY is still green around 775.8. QQQ is still leading around 730.8. But VIX at 19.62 is not exactly asleep. Bonds are still bid too, with TLT around 82.6, so the tape hasn't fully panicked. But the easy rates comfort blanket just got tugged. Next headline. AI spending and AI security fears are fueling volatility across equities, bonds, and credit. That matters because AI is not just a tech headline anymore. It's a CapEx story, a credit story, and a duration story, all wearing the same hoodie. We're seeing that in names tied to the theme, including MSFT and even today's wild high beta crowd like XHG. The macro desk read here is simple. QQQ can be up almost 1% and still have a pretty jumpy undercurrent if the market starts questioning how profitable, safe, or scalable all this AI spending really is. And third, geopolitical tension, tariffs, shifting oil supply, Middle East unease is keeping commodity swings and safe haven demand in play. Why it matters? Energy touches inflation, margins, consumers, airlines, transports, and the whole central bank conversation. Today's cross-asset board is messy, though. The oil proxy is softer around 126.70. Gold is down about 1.16%. So this is not a clean panic bid. It's more like headline risk soup. And nobody loves soup with treasury yields in it. XOM and CVX stay on the affected list there. Coming up, the markets desk gets right back to the movers board, and we'll see who's actually catching the bid after this news hit.
Thanks, Macro Desk. Let's check the Stock Whisperer book real quick. Alright, this is the show's simulated $100,000 paper portfolio. Not a recommendation to copy anything. We've got about 45.6 thousand in cash, and the tape is still mixed. QQQ holding around 730.8, VIX still sticky near 19.6, so I'm not forcing anything here. On the green to flat side, Ford is up about 21 bucks, NVDA is up about 9 bucks, and XOM is basically flat. Those are fine. Nothing heroic, nothing broken. Thesis, level, defined risk, that's the process. Now, the stress in the book is pretty clear. MU is down about $62, SMCI is down about $174, and the USO short is underwater by about $135. SMCI is the one I'm grading the hardest, because the original thesis was that upside revenue guide shock and AI infrastructure momentum, but price is not paying us yet. Entry is 40.755, current is around 39.89, and the paper stop is 38.90. So that's defined risk, not hope. MU is similar. Partnership news thesis is still alive as long as the bracket keeps it contained. The stop there is 945. USO, I'll be honest, I don't love that I'm not seeing an open bracket in this blotter right now. So that one is on manual watch until the next decision point. Let's flip to the working orders, the active bracket protection I care about. XOM has its stop at 154.80, SMCI at 38.90, MU at 945, and NVDA at 219.40. That's the guardrail side of the book. On the watch list, XOM above 160.50 is the clean energy continuation trigger I'm watching. NVDA below 223.50 would be my AI leadership warning line, and MSFT 500 is still the round number confirmation level for software strength. But we don't have a position there. So no new paper trades from the Stock Whisperer right now. Let the levels do the work. Coming up, Market Movers Scan.
Thanks, Stock Whisperer. Alright, markets desk grabbing the movers board. And oof, this board is loud. Markets only mixed to green, SPY up about 0.5%, QQQ up 1%, VIX still firm near 19.6, but the small cap board is doing its own thing. XHG at the top, up 277%, 64 million shares, relative volume over 4,000. That is not normal. FGI right behind it, up 225%, 74 million shares. DFSC up 74%, also 74 million shares. LIMN is the penny biotech volume monster, 453 million shares. And then you've got LESL on the other side, down 44%. So this is not just squeeze city. There's liquidation on the loser side too. We're going chart by chart, fast, levels only. Now, XHG first, because this is the crazy one. Up 277% at about 345. And remember that 350 downside level the markets desk flagged earlier already hit. So now 350 flips from breakdown line to reclaim line. That's the whole read for me right here. The volume is real. 64 million shares traded versus an average around 14,000. Relative volume over 4470. But that does not make it clean. Reported float is basically microscopic. Market cap is only about 3.4 million, and the dilution risk tag is high. So yeah, it can move violently, but it can also rug hard. I'm watching 350 on the 1 minute. Reclaim it and hold above, the tape can calm down a little. Keep failing there, and this stays in fade risk mode. No victory lap just because it's green 277%. FGI next. And this one is not quiet either. We're talking a 225% squeeze, trading around 15.37, and the volume is the confirmation piece, 74 million shares versus an average around 326,000. That is ridiculous relative volume. Tiny float too, about 520,000 shares. So yeah, this can move in chunks. What I'm watching on the 1 minute is whether that 15 area starts acting like an actual shelf, not just a random pause after the squeeze. If buyers keep accepting above 15, that tells you the chase is still alive. If it starts knifing back under that shelf, that's where these low float squeezes can go from clean momentum to air pocket really fast. Now DFSC. Different story. defense and industrial angle, but the tape is still very small cap momentum. It's up about 74%, sitting near 2.16, and volume is basically the whole story again. 74.6 million shares on a name that averages under 600,000. So the crowd found it. The level here is cleaner for me, $2. Above 2, it can keep trying to base and grind, especially if dips keep getting bought quickly. Under 2, that becomes the trapdoor line, because everybody who chased the 2 handle suddenly has the same problem at the same time. So I don't want to overcomplicate DFSC. Watch the 2.00 reclaim hold game versus a flush back through it. LIMN now, and this is where you've got to slow your brain down a little, because the percentage move looks exciting, but the stock is trading around 16 cents. This is penny stock biotech, clinical stage cancer therapy name, and the board is showing 453 million shares traded. That is wild. Relative volume over 1,500 times normal, off an average day of only about 300,000 shares. So yeah, the tape is awake, no question. But this is also high dilution risk territory, and at 16 cents, tiny absolute moves are huge percentage swings. The level I'm watching is basically this 16-cent area. If it keeps accepting above there, the momentum crowd stays interested. If 16 starts failing, that can turn into a liquidity trap really fast. BYSI is the cleaner biotech comparison right behind it. Same healthcare momentum pocket, also high dilution risk, but very different tape feel from LIMN. This one's around $1.08, up 45%, 19.7 million shares traded, 74 times relative volume. Still huge, just not the absolute volume hurricane we're seeing in LIMN. So for BYSI, I'm checking whether the bid is actually holding around this 108 area, or whether it's just sympathy that's starting to run out of steam. If it can keep building above $1.08, that's cleaner continuation behavior. If it starts rejecting that area and the candles get heavy, LESL on the loser side now, and this is the one where the board flips from chase mode to damage control mode. Down about 44%, trading around 74 cents, and the volume's heavy too, over 4.6 million, roughly 24 times normal. It does have recent filings flagged, so for a name this beaten up, I'm not just asking is it cheap, I'm asking are sellers still leaning on every bounce? If it can't stabilize around this 74-cent area, that's not a bounce yet, that's just a pause in the flush. Now quick rotation to the other green names. ARX is actually the cleaner large cap leadership name on this board. 2.2 billion market cap, up 43%, almost 48 million shares traded. Totally different quality of move versus the tiny float rockets we started with. Curry, that's more of the media squeeze pocket, up about 40%, around 3.91, with 35 times relative volume, so that one's got attention, but it's still a smaller, faster tape. GXAI is the AI/gaming momentum name, up 37%, 72 million shares, 461 times relative volume, but high dilution risk. So yeah, fun chart to watch, not one to get casual with. And one last red check, FGL down 41% at about 46 cents, but relative volume's only around half its average, so it's ugly, just not the same kind of panic volume event as LESL. Alright, that's the movers board. We'll keep these levels live, and we're flipping from here into the next check. Alright, quick candle lab. Markets Desk is pulling up BAOS, because this one is a clean little lesson in failed momentum. Look at the shape right away. Opens around 60 cents, dips, then snaps to almost 62 cents. Nice first push, but the key is not the push, it's what happened after. This thing round-tripped. Okay, now watch the volume tell the story. The breakout candle up through 61 cents had volume behind it. Over 12,000 shares. Then later you get a bigger participation burst near 38,000. So at first, yeah, buyers were actually there. But then, oof, look at that reversal. After the stall around 61, volume dries up. Price stops advancing. And then, sellers absolutely hit it. The bigger tell is the dump from roughly 60.7 cents down toward 58.5 cents, with that huge 73,000 share volume spike. That is not a quiet pullback. That's supply showing up. So here at the Markets Desk, I'm treating 61 cents as the reclaim line. Above 61, maybe the tape repairs a little. Below that, it's still a failed breakout living under resistance. Right now, BAOS is trying to bounce off that 58 to 59 cent pocket. Last read around 59.5 cents, but the bounce is low volume. That matters. A real repair candle should not feel sleepy after a heavy volume sell wave. So the two lines are simple. Watch 61 cents above for a reclaim, and watch 58.5 cents below, because that's where the base starts to fail. If 58.5 cracks, this is just a fade that found a pause. If 61 gets reclaimed with actual volume, then we can reassess the character. Coming up, we've got the Pro Terminal plug, then we're right back into the market overview.
Thanks, Markets Desk. Okay, macro check on the 12:30 data. Because this is the part of the day where the tape stops pretending it's just about one stock. PPI month over month came in at 0 versus 0.2 expected. Core PPI, 0.2 versus 0.3 expected. Jobless claims, 209K versus 202K expected. So the headline cocktail is pretty simple. A little cooler on pipeline inflation, a little softer on labor. And that's why the Nasdaq is wearing the party hat. QQQ's around 732, up about 1.15%. SPY's 776 and change, up roughly 0.5%. Russell's only up 0.16. So this is still big cap growth doing the heavy lifting, not some grand all clear across the whole market. And VIX is still 19.6, green on the day. So yeah, the market's smiling, but it's doing it through clenched teeth. Here at the macro desk, the chain reaction is the whole story. Cooler PPI means less immediate pressure on inflation-sensitive yields, so bonds catch a bid. TLT's up about 0.62% at 82.62. IEF's up 0.37 at 93.31. And yeah, that TLT 8250 level we flagged earlier got hit. Not victory lapping too hard, but the tape did tap the glass there. That lower yield impulse is exactly why duration-heavy growth gets the first bounce, which is your QQQ outperformance versus SPY and IWM. But the dollar is not giving equities a totally clean green light. UUP is sitting right at 28.20, basically flat, and that was another level from earlier that got tagged. Meanwhile, gold's getting clipped, down about 1.45% to 399.06 on the tape, and oil's down about 0.64 to 126.49. So the safe haven and inflation hedge bid is cooling at the margin, even while the headline machine is still doing what headline machines do, yelling at us in all caps. Now zoom out, and the cross-asset follow-through is basically the same risk thermostat. Bonds caught the bid. TLT up about 0.6, IEF up about 0.4. So the post-data read is, yields cooled, at least for now. Dollar is not really breaking though. UUP is sitting right around 28.20. Yen is barely green, so this isn't some giant dollar unwind. Gold's actually off about 1.5%. Oil's down about 0.6. And that matters because if oil starts re-accelerating, the inflation conversation can get messy again pretty fast. Then look at the crypto equity split. BITO's slightly green, MSTR's up about 0.75%, but COIN is lagging, down almost 0.9. That's not crazy. Coin trades more like an exchange and fee equity, so it can lag when the market's not paying up for volume beta, while MSTR and BITO can hold up better when the Bitcoin proxy bid is still there. All right, next macro landmine. Said Barkin hits the mic at 12:40 Eastern. I'm not predicting the Fed off one speech, but the desk radar is simple. VIX 20 is the stress line. QQQ 730 is the tech risk line. TLT holding 8250 and trying toward 83 says bonds are confirming the cooler data reaction. And UUP 2820 is the dollar pivot. If bonds fade and the dollar firms back through that area, equities may stop liking the data. If QQQ keeps holding 730 with VIX under 20, the risk bid still has room to breathe. That's the macro map. Let's hand it back to the tape and hit the next charts.
Thanks. Macro Desk. Quick Pro Terminal lap, because this is exactly why the Markets Desk lives inside this platform all day. First up, Dilution Center. When these small cap runners start flying, I don't just stare at the green candle. I want to know, shelf registration, ATM, offering risk? Is there paper waiting above the tape? That stuff matters. It doesn't tell you what to do, but it keeps you from trading blind. Educational only, obviously. Markets are messy, data can change, and risk is real. Now hit the movers board. This is the pulse check. Top gainers, top losers, relative volume, price, market cap, when it's there. Boom! All in one shot. And look, this is not a buy list. Never. It's a research board. It tells you where the tape is loud. QQQ is green. VIX is still sticky. Breadth is mixed. So if a name is exploding while the rest of the market is just kind of grinding, that relative strength jumps off the page. Same thing on the loser side. Damage control names show up fast. Then before I get too cute on any one ticker, I open the profile. We'll use XHG as the example because it's been all over the board today. Filings first. I'm looking for recent 8Ks, S1s, shelves, warrants, anything that explains why supply might hit the stock. Then I'll flip insiders. Insider activity is context, not a magic signal, but it's another layer. That's the whole point here. Don't trade a headline in a vacuum. Chart, volume, filings, dilution, insider context. Stack the evidence, don't chase the noise. And then we drop it right back onto the 1-minute chart. This is where the market's desk lives. Candles, volume bursts, wick behavior, where buyers actually showed up, where sellers smacked it back down. Oof, look at that type of tape. That's why I want the chart next to the filings, not 5 tabs away. Everything you're seeing here, movers, dilution, filings, insider data, and the live chart workflow, that's ProTerminal. Coming up, we roll back into the market overview. But if you want the same research stack on your screen, sign up at proterminal.io.
Thanks. Markets desk? Okay, quick macro check. Because the tape is doing that fun little thing where it looks green until you ask it 2 follow-up questions. SPY is at 776.5, up about 0.5%. QQQ is the clear leader at 731.8, up 1.12%. And IWM is barely participating, up 0.17%, around 303.2. So the message is not, quote, everything is awesome. The message is big cap duration is getting the vote. Small caps are still asking for ID at the door. And the tell is VIX. 19.59, still green by about 0.7%, even with equities green. That's not panic, but it's not a beach chair either. Here at the macro desk, that reads like a market willing to own tech, but still keeping one hand near the umbrella, because rates, Fed speakers, and inflation are still in the room making eye contact. Thanks. Markets desk, breaking AI credit headline first. ProTerminal's newsroom is tracking this right now. NVIDIA has lined up major Wall Street underwriters for AI data center debt tied to customer financing, with dedicated capital pools reported at more than $500 billion across 6 major firms. That's the fact set. What we don't know yet: exact pricing, maturity structure, covenants, which customers draw first, and how much of this becomes actual debt versus just available firepower. Market read: this is NVIDIA moving from chip supplier to AI infrastructure financier. Basically the toll road and maybe the road crew too. With QQQ still around 731.6 and above that 730 risk line the macro desk flagged, the tape is treating AI capex as supportive for now. But the grown-up question is credit. Who carries the leverage if server farm economics get even a little less magical? Next headline: oil and treasury yields are climbing on Middle East tension and inflation concerns. The desk is seeing the market price in risk around the Strait of Hormuz. And that matters because energy is the sneakiest tax in the economy. It shows up in shipping, margins, airfares, groceries, the whole annoying receipt. Live tape is a little more nuanced though. Oil is around 126.03 and actually down about 1% on the session, so the headline risk premium is there, but it's not a straight line chase right this second. The investor impact is rate sensitive. Housing, consumer credit, and long-duration growth all start doing math when energy and yields rise together. Third headline, Fed's hammock is signaling more rate hikes may be needed. That lands into a market that just got softer PPI earlier. Headline PPI at 0 month-over-month versus 0.2 expected. So yeah, the bond market is getting mixed signals like a GPS in a parking garage. TLT is still around 82.63, holding above the 82.50 line we flagged, while the dollar is sitting right near 28.20 on UUP. Why it matters? If Fed speakers keep pushing back while inflation data cools, the equity tape can hold up, but the rate volatility channel stays alive. Coming up, we'll hand it back into small cap momentum, where none of these companies appear to have discovered bond covenants yet.
Thanks, Macro Desk. All right, Markets Desk is grabbing SECZ because this is exactly the kind of midday small cap tape that can trap people. Pulling up the 1 minute now. SECZ is down about 22.5%, around 6.06. And that matters because QQQ is green, SPY is green, IWM is barely green. So this isn't just the market dragging it lower. This is relative weakness. Early pop, 6.24 open, push to 6.39, and then, oof, look at the fade. Here's the tape red. The first move looked decent for what, 20 minutes? Then sellers just took control. Lower high, lower low, lower high, lower low. That's not healthy momentum. Volume showed up near the 639 high, but the important part is volume also came in on the breakdown towards 605. That tells you the flush was confirmed. It wasn't just sleepy lunchtime drift. Right now it's trying to build a tiny base from 606 to 608, but the volume is lighter, so I'm not calling that a reversal. I don't have a VWAP print in this feed, so here at the Markets Desk, I'm using the clean tape levels. 624 is the reclaim line back through the open, and 604 is the day low failure line. Above 624 with real volume, the fade starts to repair. Below 604, that base is gone. Quick catalyst check, because small cap charts don't move in a vacuum. SECZ Securitize reported second quarter results after the close yesterday. The company is in tokenized real-world assets, blockchain-based securities infrastructure, that whole regulated tokenization lane. You've also got recent headlines about becoming a registered investment advisor and working with Cantor on on-chain IPOs and follow-ons. Cool theme, very buzzy theme, but the chart is voting right now, and the chart is saying buyers bought the story early and then sellers leaned on it hard. Back to the 1 minute to score it. This is not a clean momentum runner yet. It's a failed breakout trying not to become another leg lower. Price is about $6, so not sub-dime penny stock chaos, but it's still a newly combined small cap style name with real gap risk, whipsaw risk, and filing or dilution risk if the story changes. The levels are simple. Watch 604 below, watch 624 above. Everything between is chop until the tape proves otherwise. Coming up, mega cap watch. We'll see if the big cap bid is still carrying this market. All right, let's shift from the small cap chaos to JPM. Big bank, big chart, clean levels. Markets Desk has the daily up first. Stocks sitting around 362, 363, down about 0.75%, while SPY's green and QQQ's ripping over 1%. So right away, this is not the leadership pocket today. Tech has the baton. JPM is digesting. Daily chart is still strong though. Don't confuse lagging today with broken. Over the last 90 days, JPM's gone from that lower range near 292.70, then it built higher lows, higher highs, and pushed into the mid 360s. The big lid is 366.50. That's the level the chart has not cleanly cleared yet. And look at the volume read. The big upside days had real volume behind them. Then the recent pullback has been lighter. That's usually more pause than panic. But oof, it is stretched. RSI around 65, Williams near overbought, ADX only around 15.7. So momentum's there, but it's not some runaway trend. For me, 366.50 above is the daily breakout line. Under 350, that's where the upper range look starts getting tired. Now let's drop down to the 1 minute, because this is where the tape tells the truth. JPM's not trending hard intraday, it's boxing. low around 361.58, high around 363.31. And most of the action is just ping pong inside that range. You've got higher lows trying to form near 361.80, then every push up toward 363.30 gets supply. Volume showed up on a little sell hit around 361.95, then volume picked back up into the 362.70 to 363.30 push, but it faded. That's the key. Buyers are present, sellers are present, nobody has full control. Right now it's holding near the upper end with small-bodied candles. So the market's desk scoreboard is simple. Above 363.30 and hold, banks get a little pulse. Below 361.58, that base fails and the intraday structure changes fast. So net on JPM. Daily trend still intact, but today it's lagging a green tape. That matters. QQQ just hit that 730 area the macro desk flagged. Growth is getting the bid, and JPM is basically saying, yeah, I'm fine, but I'm not leading this move. Keep 366.50 on the daily. Keep 363.30 and 361.58 on the 1 minute. No hero read needed, just levels and confirmation. Coming up, we'll spin back to the movers board and see where the real heat is. All right, let's hit the movers board, because this thing is spicy right now. QQQ's up just over 1%. SPY's green, IWM barely green, VIX still hanging around 1960. So the tape is supportive, but it's not some full send small cap party. And then look at this board. FGI up 277%. XHG up 265, DFSC up 82, LIMN still holding a 55% move, GXAI up 47. Oof. That's not market beta. That's pure event flow, float pressure, and volume chasing. FGI is the headliner here. 82 million shares traded versus a tiny reported float around 520,000. That is exactly the kind of math where candles get violent fast. So here at the markets desk, we're not worshiping the percent gain, we're checking, is the 1 minute still accepting higher, or is this just late liquidity getting fed into the offer? Okay, pull up FGI first. This is the monster on the board. FGI Industries, consumer cyclical, kitchen and bath products. Not exactly the sexiest story on earth, but the tape does not care when the float is this tight. Price is around $17.85, up 277%, 82.6 million shares already. Relative volume 253 times normal. That is insane turnover. The simple line for me is $18. If it can reclaim and keep accepting above 18 on the 1 minute, then you can at least say buyers are still pressing the high end of the move. If it keeps rejecting under 18, that's where these low float moves can turn into nasty Wick City real quick. And because the reported float is only about 519,000 shares with medium dilution risk showing, this is not a casual name. This is tape reading only. No hero stuff. Watch the volume bursts. Watch whether pullbacks get bought, and watch whether 18 becomes support or stays resistance.
Thanks, Markets Desk. Quick Stock Whisperer check-in on the new PYPL paper trade. This is the show's simulated paper portfolio, not something I'm telling anyone to copy. We just opened PYPL long, 150 shares, average right around 59.62. The setup is pretty simple. Fresh beat and raise catalyst, and it's holding a constructive midday bid while QQQ is still leading the tape, up a little over 1%. The bracket is already defined. Risk is below 57.40, and the take profit order is sitting up at 64.50. So, for me, here at the Stock Whisperer, the trade is not about chasing the headline. It's thesis, level, bracket. If it loses that 57.40 line, the idea is wrong in the sim. If it can keep holding bid and work towards 64.50, great, the bracket does its job. Rest of the book, quick and honest. F is basically a scratch winner, up about $21. NVDA is barely green, up $5, still tied to that AI infrastructure catalyst and the 223.50 support watch. PYPL is flat right after entry. SMCI is the one dragging, down about $203, and that stop at 38.90 is the line I'm respecting. USO short is red by about $135, so oil strength is still working against that hedge. XOM is flat green, only up a couple bucks, with its bracket still on. Cash is about 43.3K. On the watch side, I'm still watching GD above 395 for defense follow-through, SPGI below 410 for earnings miscontinuation, and NVDA below 223.50 as the AI momentum warning line. Coming up, we'll kick it back into the next pro-terminal look.
Thanks, Stock Whisperer. All right, quick vol check, because this tape's got a little wrinkle in it. We've got SPY up about 0.5%, QQQ up a little over 1% at 732, but VIX is still green at 1961. That's not panic. That's more like the market wearing a raincoat on a sunny day. Slightly weird, but not insane. Here at the macro desk, the line is still 20 on VIX. If we start accepting above 20 while QQQ is holding 730 plus, that tells you people are paying for protection even as they chase growth. If VIX can't get through 20 and fades back under the mid-19s, then this is just post-data indigestion after PPI, jobless claims, and the Fed speakers. Now let's put that into a single name lens with SPGI. Pulling up the 1 minute, this is not a meme stock volatility chart. This is a big financial data name trading like a coiled range. Price opened around 414.70, flushed to 411.37 early, then spent the middle of the session basing around 412.20 to 412.90. The interesting part is the recovery. Last candles are pressing back near 414.67, basically right under the day high area at 414.74. So for options people, and I mean educationally here, the question isn't which way do I guess? It's whether realized movement actually expands. A $3 and change intraday range on a $413 stock is controlled. If SPGI clears and holds above 414.75 with volume, that's the range trying to wake up. If it loses 412.20 again, that early sell pressure is back in the room. Very different volatility story, depending on which side of the box wins.
Thanks, Macro Desk. Quick pit stop, because this is the stack we're using all show. This is Pro Terminal. Movers, charts, filings, insider stuff, dilution risk, all in one place. And yeah, here at the Markets Desk, I care about this page a lot. Dilution center first. If you're trading small caps and you don't know whether there's a shelf, an ATM, or recent offering risk hanging over the name, oof, you're flying blind. Now flip back to the board. This is where the chaos starts. But it's not a buy list. Big difference. It's a radar. You've got the top gainers, losers, price, relative volume, market cap context. And in a tape where QQQ is up over 1% while breadth is mixed, relative strength actually matters. XHG, FGI, DFSC, LIMN, these are the types of names we can find fast, then immediately ask, is this real volume or is it just a spike and rug setup? And this is the part traders skip when they're moving too fast. Pull up a name, hit the filings. Recent SEC filings can completely change the risk profile. Offerings, shelves, warrants, all that fun small cap landmine stuff. Then I want the insider tab too. Not because one filing gives you the whole answer. It doesn't. Data can be incomplete or delayed. But it gives you context before you start trusting a candle. That's the workflow. Chart gets your attention. Filings tell you what you're actually standing on. Then, right back to the 1 minute chart. This is where we keep score live. Wicks, volume, VWAP behavior, failed breakouts, reclaim attempts. Everything you see us use on air. Market movers, terminal charts, dilution center, filings, insider trades. That's Pro Terminal. Use it for research, not as a magic green button machine. This stream is educational. If you want the same setup on your screen, go to proterminal.io. Coming up, we'll roll straight into small cap momentum.
All right, pull up FGI. This is the small cap momentum test right now. Here at the Markets Desk, this is the kind of chart you stop on. QQQ's green, SPY's green, breadth is mixed, and FGI is still showing monster board strength with roughly 257 times relative volume. Oof. Open near 1158, early wash under 11, day low 1041, then bang, character change. breakout through 13, volume burst over 700K shares, and then it ran straight into the high 19s. That's not a grind. That's a squeeze candle stack. Now look at the right edge. This is where the story gets useful. FGI tagged 1993, then immediately gave back a nasty chunk of the move and started basing around the high 16s, low 17s. Last read is around 1725, so no victory lap yet. The volume confirmed the breakout, yes, multiple 500K plus spikes, real participation, but the pullback also had size behind it. That means this is not clean trend anymore. It's squeeze versus distribution. I don't have a clean VWAP number in this feed, so I'm not going to fake it. The printed tape level is 1650. If 1650 breaks below, that base is gone, and this can air pocket fast. If it can reclaim and actually accept above 1993, that's the high of day pressure point where shorts have to answer. Catalyst check quick. The fresh company item is yesterday after the close. FGI announced second quarter 2026 results. And just so we're framing it correctly, this is not an AI headline, not a biotech readout, it's kitchen and bath products. Consumer cyclical, tiny market cap around 28 million bucks. Float is about 520,000 shares. Shares outstanding about 1.93 million. So, when you see 73 million shares traded, that's absurd float turnover, well over 100 times the float. Now flip to dilution, because this is the part that bites on small cap runners. ProTerminal has overall dilution risk at medium, 3 active shelves, an active equity line, and roughly $1.12 million listed as total raisable amount. Not saying that hits today, just saying with a parabolic microfloat chart, overhead supply risk matters. Back to the 1 minute. This is the scorecard. Real momentum needs that 1650 area to keep absorbing. After the rug pull from 1993, if it loses 1650, I'm treating that as failed base behavior, not momentum. If it pushes back toward the high, I want to see volume expand again, not little thin candles walking up on no participation. 500,000 float names can halt, reverse, and trap people fast. So this is levels only, no hype. Coming up, we'll flip into VBIO for a straight candle read. Alright, quick candle lab. Let's pull up VBIO and read the 1 minute tape. This is not a clean trend. It's a tiny sideways bio tape sitting around 16-17 cents. Day high is about 0.182, day low 0.165, and the current area is right near 0.1675. So right away, here at the markets desk, I'm treating this as a base after damage, not a clean momentum push. Oof, look at that flush candle. Earlier, VBIO was chopping between roughly 0.174 and 0.177. You had volume bursts around 48,000 shares, then 45,000 shares, but no real directional breakout. That's important. Volume showed up, price didn't hold a higher shelf. Then the real expansion was down, sharp hit into 0.165 on about 170,000 shares. That's the candle that matters. Sellers actually confirmed that move. The bounce back into 0.172 to 0.174 happened, but the volume cooled off. So the bounce is not screaming accumulation yet. If VBIO wants to clean this chart up, 0.175 is the reclaim level I care about above. Until that happens, it's still trading below the open, near 0.177, and below the real resistance zone.
Thanks, Markets Desk. Top of the hour. Quick market minute for everybody just sliding in. It's 1:01 p.m. Eastern, and the tape is green, but it's not exactly a parade with a brass band. SPY's at 776.94, up about 0.6. QQQ is the clear muscle at 732.39, up 1.2%. IWM's barely green at 303.26, up 0.2. And VIX is still hanging around 19.58, also green. So the story is pretty simple. Megacap Nasdaq is doing the lifting. Small caps are more like, yeah, sure, I'll come along. And breadth is mixed. The catalyst combo today is cooler inflation pressure. Headline PPI came in flat versus plus 0.2 expected. Core PPI plus 0.2 versus plus 0.3 expected, while jobless claims were a little higher at 209 versus 202. That's the market hearing less inflation heat and a touch softer labor, and immediately asking, okay, where's my duration tech? Now the cross-asset tape actually lines up with that. Bonds are catching a bid. TLT at 82.545, up about 0.5%. IEF at 93.30, up 0.4. That's the rates temperature gauge cooling off a bit. The dollar's basically parked at 28.20. Yen exposure is flattish at 57.53. So FX is not screaming stress here. But look at the commodity side. Gold's down 1.07% to 400.585. Oil's down the same 1.07% to 125.943. That's the safe haven / panic premium pocket deflating, while tech gets the benefit of lower rate math. And crypto-linked risk is not really joining the party. BITO down 0.4, coin down 0.75, MSTR slightly red. So this is selective risk appetite, not a giant confetti cannon. Here at the macro desk, that's the map. Cooler PPI helps NASDAQ, bonds confirm it, commodities fade, but VIX in the high 19s says protection has not left the building. Coming up, we've still got the market movers scan and then mega cap watch on deck. All right, quick macro check. Here at the macro desk, the tape is telling one pretty specific story right now. We got headline PPI at 0 versus a 0.2 estimate, core PPI at 0.2 versus 0.3 expected, and jobless claims at 209 versus 202. So the market hears less inflation pressure, just a little softness in labor, and immediately the duration trade starts putting its shoes on. SPY's at 776.94, up 0.58%. QQQ's doing the heavy lifting at 732.39, up 1.20%, while IWM is only up 0.18% at 303.26. That's not broad animal spirits. That's big growth getting the first plate at the buffet. And the annoying little wrinkle, because macro always has to ruin a nice lunch, is VIX still green at 19.58. Under 20, fine. Above 20, that protection bid starts mattering again. Now the confirmation is coming from bonds. TLT is 82.545, up 0.53%. IEF is 93.30, up 0.37%. That's the market saying, okay, softer PPI means duration gets a bid. And remember, the TLT 8250 level we flagged earlier actually got tagged, so that wasn't just noise. That was the bond market voting with real money. That's why QQQ can outperform SPY here. Lower rate pressure makes long duration tech look less expensive on the margin. The dollar, though, is not collapsing. UUP is basically parked at 28.20. Yen proxy FXY is 57.53, up a tiny 0.02%. So this is not some dramatic FX panic. This is more like the rate market quietly turning the thermostat down and tech immediately acting like someone opened a window. Now, cross-check the commodity board because this is actually pretty clean. Gold sitting at 400.585, down 1.07%, and oil's at 125.943, also down 1.07%. So you've got bonds bid, growth up, and commodities fading. That's not screaming panic bid into hard assets. It's more like safe haven demand is cooling in gold, and some of that inflation premium is coming out of crude after the softer PPI print. Now, the one spot that's not confirming the NASDAQ strength is crypto beta. BITO's down 0.42%, coin down 0.76%, MSTR down 0.24%, while QQQ is still up around 1.2%. So, yeah, tech is acting better, but crypto equities are not exactly joining the party. Levels into the next tape check. VIX 20 is the line. Above that, risk gets noisy fast. QQQ 732.50 is the upside pivot we've been leaning on. TLT 82.50 needs to hold if the bond bid is real. And UUP 28.20 is the dollar flatline. If that starts pushing higher, watch pressure come back into risk. All right, macro map is set. let's hand it back to the movers tape and see where the actual flow is hitting.
Thanks, Macro Desk. All right, Markets Desk is back on the movers board, and this board is not subtle. QQQ's green, SPY's green, Brett is still mixed, and VIX is weirdly bid. So when you see these tiny names up triple digits, you've got to separate real momentum from just air pockets. Top of the board, XHG, up 304%. That is not a typo. 66 million shares traded, relative volume over 4,600 times normal. Oof. Then FGI. We already flagged that 1650 line earlier, and that just hit to the downside at 104. So that runner is now in scoreboard mode, not victory lap mode. DFSC is next, up 121%, 85 million shares. LIMN, 16-cent biotech, almost 500 million shares traded. GXAI, ARX, then LESL on the loser side down 43%. This is exactly why we use the board as radar, not a buy button. Now we're going chart by chart. Pull up XHG first, because this thing is the headline freak show. 1 minute chart, XHG, trading around 370, up about 304%. And the volume number is just absurd, 66.5 million shares versus an average around 14,000. Reported float is tiny, 415 shares on the feed, so I'm treating this like ultra-thin, split-adjusted chaos. Real estate services, China insurance agency business, market cap around 3.4 million, high dilution risk on the board. So yeah, the move is massive, but the structure matters more than the headline. For me, 370 is the live line right here. If it can hold above that area and stay over VWAP, fine, the bid is still fighting. If it starts living below 370, and especially under VWAP, that's where these parabolic names can turn from squeeze to trap fast. No chasing talk here, just tape, volume, and risk. Now FGI. This is the one we called out earlier at 1650. And yeah, that level did get tagged. Good hit. But look at what matters now. It's back around 1495. Still up more than 200%. Still 84 million shares traded. But the chart's not the same as when it was ripping. This is where you ask, is the bounce actually getting bought, or are we just watching late longs try to unwind without getting smoked? For me, 1650 is the line that proves buyers are back in control. Under that, if it keeps stalling in the mid-15s and slipping back toward 1450, that's not fresh momentum. That's supply showing up after the squeeze. All right, DFSC next. Totally different feel, but same small cap tape problem. Aerospace and defense name, trading around 274, up about 121%, and the volume is wild. 85.6 million shares, roughly 148 times normal. So the attention is real. The question is whether VWAP is acting like a launch pad or a magnet. If DFSC can keep holding above that 270 area and stop giving back every push, that's constructive. If it loses VWAP and starts chopping under 260, that's where these runners can turn into a very annoying fade. Medium dilution risk here too, so I'm not treating this like a clean institutional breakout. It's still a momentum trade with trap risk all over it.
Thanks, Markets Desk. Quick stock whisperer check on the simulated paper book. We just opened GXAI. Long 2,500 shares, average 1.245, marking 1.2401 right now. So basically flat, down 12 bucks. No victory lap here. The setup is clean enough for a paper entry. Fresh record Q2 revenue, that big 1,337% year-over-year headline. And compared with the really violent small cap earnings spikes on the board, GXAI's reaction is sharp, but not as stretched. So here at the Stock Whisperer, the thesis is simple. Catalyst, controlled reaction, defined risk. If the bid holds, fine. If it doesn't, the bracket handles it. Here's the bracket on GXAI. Stop is sitting at 1.08. Take profit order is up at 1.65. That's roughly 16.5 cents of risk per share from entry. A little over 400 bucks on the simulated account versus about $1,000 if the upside limit gets tagged. Rest of the book quick. F is green by about 21 bucks, NVDA green by about 21. PYPL is slightly red, XOM is flat, and SMCI is the one I'm grading hardest, down 156, while QQQ is still green, so that relative weakness matters. Other brackets are still live on PYPL, NVDA, and XOM, no change there. Watch list is FGI above 1525, DFSC above 255, and NVDA losing 223.50 would weaken that existing AI long. Again, this is the broadcast simulated paper portfolio. Process only, not a copy button. Coming up, we kick it back into the Pro Terminal flow.
Thanks, Stock Whisperer. Let's hit Apple fast. AAPL's green, but barely. Stock's around 303.6, up about 45 bips, while QQQ is up 1.28%. So yeah, Apple is not the leader here. Daily chart first. This thing ripped from the mid-240s into that 344.57 high, then got smoked back toward 275, and now it's just trying to stabilize around 303. The problem? It's still living below the short and medium-term averages. That 309 to 310 area is the first real supply shelf. Above that, 316.50 is the bigger daily resistance. For now, this is a pullback base, not a clean leadership chart. Alright, drop it to the 1 minute. Oof, look at how tight this is. AAPL is basically trapped between 302.70 and 303.70. Dips under 303 are getting volume. That's the sellers showing up. But they're not getting paid much yet because buyers keep defending that 302.70, 302.80 pocket. So, here at the markets desk, the live scorecard is simple. Above 303.70, Apple starts to clean up intraday. Below 302.70, that base breaks, and the lag versus QQQ matters a lot more. No big call here, just levels. Chop until one of those breaks with volume. Coming up, quick Pro Terminal hit, then we're back into the small cap fire.
All right, quick pit stop. Let me show you the exact cockpit we're using here at the markets desk. This is Pro Terminal. Same movers board we've been living on all session. Top gainers, losers, relative volume, price, the whole heat map. And yeah, this is not a buy list. It's a research starting line. Then we click straight into the tape. 1 minute chart, candles, volume, the stuff that actually tells you whether a move has pressure behind it or it's just a headline spike getting faded. Look at this. When we're calling out wicks, VWAP tests, volume bursts, that's all right here. Fast. No digging through 5 tabs while the stock's already moved. And for the small cap runners, this page matters a ton. Dilution center, shells, ATMs, offerings, risk flags. Oof. This is the page that keeps you honest when something is up triple digits and chat is screaming. A chart can be clean for 10 minutes, but if the capital structure is a mess, you want to know that before you start celebrating the move. Last piece, company pages, filings, news, insider trades, fundamentals when they're there. We're not guessing the catalyst, we're checking it. Data can be incomplete or delayed sometimes, so you still have to think, but this puts the evidence on one screen. Everything you're seeing on the stream, movers, charts, dilution, filings, insider activity, that's Pro Terminal. If you want the same setup, it's proterminal.io. Sign up at proterminal.io.
Alright, that's the wrap from the markets desk. QQQ led the tape, breadth stayed messy, and the momentum board was pure chaos. Scoreboard, XHG and GXAI levels hit. DFSC got sloppy. We'll own that. Protect your